What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Payroll's just around the corner. Equities higher. Welcome to the program. Before we get to the weekend, let's deal with this. Some data just ahead of us. Equities up by 0.5% on the S&P 500. On the NASDAQ, up by 0.5% as well. A lift in the equity market. If you get to the bond market, yields look like this. 2-year, 10-year, 30-year, 2-year. Just a bit higher by not even a basis point. 434.72. Looking at the FX market, only one thing to look at, really, and that's China crosses. Right now, dollar CNH, a breakdown there. So that's a stronger Chinese currency, Tom, off the back of speculation and reporting here at Bloomberg that we could get some stimulus around the property market.
About an hour ago, Bloomberg reports that we're going to see property market stimulus, which goes right to the heart of the middle class there. I'd also note, John, just general dollar weakness. I mean, are we going to see Euro 108? Did we expect that 24 hours ago? I'm not so sure. 107.71 an euro. The equity market lift, John, I wonder if we get a certain wage dynamic, a certain non-farm payroll dynamic today, if it's melt up Friday. I'm not there yet. I'm not predicting it.
Sure.
But I'm looking at a tape that's got some bid to it.
I'm thinking of Andrew Honhorst of Citi, who set the bar pretty low coming into this week for a hike from the Federal Reserve in June. He said 200K on payrolls, 0.4% on core CPI, they'd go. He acknowledged yesterday in his most recent note when he published that the timing of that is now uncertain. He still thinks we get another 225 basis point hikes, something like 50 over the coming meetings. But ultimately, there's a real feeling after the Fed speak of this week that these Federal Reserve officials have de-emphasized the near-term incoming information, payrolls today, CPI ahead of the next meeting. So I just wonder how big today's got to be just to reintroduce the idea, TK, that they could make a move this month.
I'm sorry, the inflation data is going to be a big deal coming up. What
Agreed.
day is that? I'm
the
sorry.
day before the meeting,
The 13th.
June 13th. Right. So they're going to the quiet period this weekend.
Yeah.
For those of you interested in some of the estimates out there, the median estimate in our survey is 195,000. There's a big range. There always is. It's not as big as it was in a pandemic year, so let's be clear about that. The high estimate, 252. The low, about 100K. These are the big estimates on the street right now on Wall Street. JP Morgan, bottom of the pack, 150,000. Wells Fargo, top of the pack, 210,000 TK. They look for something like 210 a little bit later. You can see there, though, Citi, 200K, B of A, 200K. And let's be clear, 3.4% unemployment, even if you think that goes to 3.5 and churning out 200,000 jobs a month, that ain't bad.
It's not bad. Even the Ferroli JP Morgan 150 statistic would be not bad in a normal economy. Sarah House joins. She's a senior economist at Wells Fargo. Sarah, in the zeitgeist this morning is a whole thrust that, yes, we're creating jobs, but they're low-paying jobs, many of them taken by new immigrants, different kinds of people than what America expects. The 200,000 big number you see this morning, what kind of jobs are those?
Yeah, so I think one thing that's important to note is in terms of the job creation that we've seen recently and what we expect here in the near term is that we're continuing to see outsized gains in areas like leisure and hospitality that have more scope for catch-up. And so that's important given that this is the lowest paying major industry that we see. And on the flip side, where we're seeing some more of the softness, it's in areas like information, professional and business services, financial services. So I think you are seeing a bit of a rotation in terms of that job quality that the American economy is creating right now.
In the partition of this jobs report, there is an optimism that will endure in this recession, and there's an idea of rolling recession or complete recession, whatever. Where do you fit into that?
Yeah, so we think that overall the U.S. economy will enter into recession, and it's probably useful to put some definitions around that since I think the people's views of recessions have gotten a little muddled. But we do expect a contraction, not just in GDP, but consumer spending, as well as some job losses. And so we're looking for that contraction to happen, probably around the fourth quarter of this year, maybe spilling over into the early part of next year. But I think when we step back and we take into account that we haven't seen the full effects of Fed tightening, and ultimately we do need to see demand come down to get inflation back to 2% on a sustained basis, we think it's going to take a contraction in overall activity.
Just to John's point earlier, how high is the bar for the Fed to hike rates, given that people are expecting a robust labor market? We got the JOLTS survey, and yet Fed rhetoric really changed the equation this week.
Yeah, so in terms of the Fed going again in June, the bar is certainly a lot higher than it was at the start of the week, and it's not because of the data. So a lot of the data is still coming pretty strong this week, but it is because of that Fed speak, and what the Fed is telling us is what's going to be a more cautious reaction to that data. And so I think in terms of today's numbers really changing that equation, I think you'd have to see probably at least 250,000 in terms of payrolls, maybe even higher, to get that 3-month moving average up. So just really see that trend accelerate. And it's also going to have to probably be corroborated by more strength coming out of wage growth than what's expected as well, and a still very low unemployment rate signaling that jobs market is still incredibly tight.
Have we abandoned data dependency simply because it's too complicated, given all of the differing kinds of signals out there?
I think we have to some extent. So I think it's in some ways the timing of this Fed pause, skip, whatever you want to call it, is pretty interesting when you consider the fact that if you look at the Bloomberg Economic Surprise Index for the U.S., it's at an 18-month high right now. And so we've actually seen the data come in much stronger than what was expected, and yet here we are talking about a hold in June. So while the Fed's telling us they are still data dependent, I think clearly it's not, every tick of the data, but it still seems to be somewhat of a strange time to kind of back off that data side and perhaps hold rates here in June.
Sarah, take the vector of wage growth and the vector of inflation now and tell me where I'm going to see an actual inflation-adjusted real wage growth. Is it this year or next year?
Yeah, so I think we're probably getting close to it this year, and a big part of that is what's happening in terms of the commodity space. So I think the fact that you're finally seeing some outright deflation in food, we're certainly going to see a big drag from energy prices here in the next CPI report. And so I think near term you could get real wage growth, but I think in terms of that, how much it persists, I think that's going to be a closer call, and we're still probably going to be looking at only modestly to roughly flat real average hourly earnings growth as we look into probably 2024.
Mike McKee emails in. He goes, ask Sarah what I should look for beneath the headline data. What is the oddity you're going to be looking for immediately within the report at 8:30?
Well, I think one big thing we still need to be very focused on is what's happening on the labor supply front. So we have seen labor demand trend down, still pretty strong, but I think in terms of the outright path of payroll growth and how many jobs we can continue to add, that still depends heavily on what's happening on the supply front. So we've had a pretty good run in terms of labor force participation, labor force growth over the past 6 months or so, either flat or higher. So can we see that continue? Because I think that suggests that the labor markets still have still might have a little bit more legs, and I think that could also help the broader economy, given what that means in terms of consumer spending.
We're speaking with Sarah House of Wells Fargo, and I have to wonder, before we let you go, on a broader level, a lot of people are looking tick by tick and seeing a slow sort of deceleration of the economy. You can argue over how quickly, you can argue over what the Fed's response is going to be, but a lot of it is becoming somewhat predictable in the fog that we're all in, and I'm wondering what tail risks you see percolating out there, not necessarily probabilities that are likely, but things that are keeping you up at night, whether it's the multifamily housing that Steve Whiting was talking about or commercial real estate.
Well, I think in some ways we're still worried about some of the bank stress. So just given that, even if the Fed doesn't raise rates from here, it's a continued squeeze. And so do you get perhaps a more discrete event which does introduce more risk and uncertainty, and you get more of an abrupt shift in some of the activity momentum because of that? I think that's one thing that we're still thinking a lot about.
Sarah House of Wells Fargo. Sarah, thank you. Going into the quiet period for the Federal Reserve, looking out for a little bit more Fed speak and a touch more data as well. 8:30 Eastern time, payrolls expected to come in somewhere around 200K in our latest survey, 195. Dare I say the Fed's done a decent job of communicating this week. Governor Jefferson, I think, leading the pack, trying to get everyone together and talk about, Tom, this skip. Not a pause.
Yeah, the skip pause thing, we started the week on that silliness, and I think it's calmed down a little bit. I think the reason it's calmed down is we're to the data. And I mean, how many times have we gasped when Makia sat next to us and we've looked at the data come out and it's like, oops, it's not what anybody expected.
We've talked a lot
Why
about
would
this.
today be different?
Makia came out with the stat. Lisa mentioned it a little bit earlier as well. It isn't since last April 2022, when we got the March payrolls report, on the day when we had a downside surprise for payrolls. And Lisa, that's been the theme. You heard Sarah mention the surprise index. Just where is the data coming in relative to expectations? Upside surprise, upside surprise, upside surprise.
The pause versus skip thing really has made me think about the economics profession generally and how it usually looks at a longer set of data over a historical period. It doesn't work on a month-to-month kind of basis in a post-pandemic economy that's still reeling with these distortions. So what we're hearing right now from the Fed is pause, literally, stop it for a second. Let's try to understand not only where we are economically, but also what our policy is doing. In that sphere, investors don't have the luxury of also pausing, of also skipping, of also not doing anything. So what do you do? How do you arrange when you cannot necessarily get an edge on whether we're going to get a recession, of how deep it's going to be, of which data is going to be most important?
Might get some healthy dissent, Tom, in the next couple of weeks. That would be interesting. Finally, the committee, and you can feel the committee splintering, the likes of Mester, Bullard.
Yeah.
Oh, Goolsby certainly doesn't want to move. I'm sure if you listen to Goolsby right now, I think he's ready just to commit to the end of it.
Yeah.
Pause, we're done.
Can I talk about a disinflation?
Your disagreement face is so loud, it's unbelievable.
Is there the Brammo
Honestly,
disagreement
every
face?
time anyone speaks, it's like, I'm ready to disagree.
No, I'm not. I was just training by my father.
Like
I will just
reflexive.
say.
Go on.
No, it's not reflexive. I'm listening to what you're saying, and I think that there could be dissent. I'm guessing there probably won't be, and I'll tell you why. Because right now, I don't hear many people saying that there still is this risk of runaway inflation. The hyperinflation kinds of arguments have kind of faded away a little bit. We're clearly seeing the peak of inflation. And so from that perspective, the idea of just taking a break is probably going to gain more traction.
Oh, they can find consensus on that. I said it verbatim yesterday. There are a couple of things they can find consensus on in the committee at the moment. One is no cuts, and the other is we can wait. They can find some consensus there, but there are others who think, based on the information, that we're not sufficiently restrictive, and that will be exacerbated if we get a hot print in about an hour and 50 minutes, and again, if we get a hot CPI right before the meeting.
Can I ask a question?
Sure.
Is corn wheat in the United Kingdom? Is wheat corn?
Why
what do you call
earth
wheat?
Are we talking about this?
Because the disinflation story, wheat is down 57% in the United States from a year ago peak. It's only down 29% in the United Kingdom if corn is wheat in the United Kingdom.
Honestly, this show's so random.
Is it corn?
I've got no idea.
That's why they watch.
I've got no idea. Is it?
Well, you have Weetabix. What are those little things?
Weetabix.
Weetabix.
Yeah.
So do you say, like, commodity exchange, do you say wheat?
I think we say wheat and corn.
Okay.
I'm not a farmer.
I don't know.
Sarah Wolf of Morgan Stanley, 7:30.
Corn.
So that's
corn
about
laws.
50 minutes from now. The corn laws is something, yeah.
Thank you.
Yeah, free trade, all of that, Adam Smith. I remember all that stuff, Tom.
Yeah.
Yeah, I was there with you in the Victorian era. This is Bloomberg.
what just happened? Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, Ukraine's air defense says 15 cruise missiles and at least 21 drones were shot down in the Kyiv region today. Now, Ukraine's capital has been attacked by Russia from air on each of the past 6 nights. No casualties were immediately reported after at least 3 people, including a child, were killed in Thursday's barrage. Now, meanwhile, drone attacks have been reported across a widening portion of Russia. Bloomberg has learned Turkish President Recep Tayyip Erdogan will tap Mehmet Şimşek as his new Treasury and Finance Minister. And Şimşek is an advocate of conventional economics. Now, supporters say his appointment will likely shore up market confidence. Şimşek is set to be in charge of all Turkey's economic policies in the new cabinet. Erdogan won re-election on Sunday, extending his more than 2 decades in power. And Jamie Dimon will visit Taiwan after wrapping up his high-profile trip to China. The stop-off by the J.P. Morgan CEO comes at a time of heightened tensions between Beijing and Washington. LVMH CEO Bernard Arnault, meanwhile, has become the latest big company boss to announce plans to visit China as Tesla CEO Elon Musk returns from his whirlwind tour of the country. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The United States does not seek conflict or confrontation with China. China and the United States should be able to work together where we can to solve some global challenges like climate. But we are prepared for vigorous competition. We will stand up for our interests, for our friends, and for our values.
That was the President of the United States on China, I think, before tripping over shortly after that. We are told the President is okay. He joked after getting off the helicopter at the White House, Tom.
But you were right before.
What's that?
You were correct. You said it doesn't matter. At his age, everybody's watching.
You can see on the news yesterday
Same
evening.
with President Trump.
This is the problem, TK. Can't get away from it. And we've said this a few times. Got to get away from just saying he's 80 years old. There's a lot of people who think he's an old 80 years old. And that's going to be a concern for a lot of people going into the election next year. Mentioned China there. The reporting for the team here at Bloomberg that China is working on a new basket of measures to support the property market, aka stimulus in the minds of a lot of people. And you can see the strength of the Chinese currency coming through a little bit early this morning. This all taking place, I'd say, Tom, about 2 hours ago.
If you stand in Shanghai or you stand in Beijing and you look around, there are properties, and many of them are residential, and many of them are the only outlet for wealth creation, or at least supposed wealth creation, in China. Someone with firsthand experience on this Bloomberg News story is Tom McKenzie. He joins us in London. Yeoman's duty, way past overtime. McKenzie clocking
should be the start of this weekend, shouldn't it?
Overtime today in London. Tom, thank you on a Friday for joining us. Tom, you've lived this in real time. Explain property in China. Is it the only outlet for the middle class to provide for a future?
Well, Tom, the pendulum has swung. When I arrived in 2016 in China, there were banners being put up, Xi Jinping saying houses are for living in, not for speculating, because the run-up in property prices was red hot, and they were putting in place restrictions to ensure you couldn't buy multiple properties, which historically is something people have done. Why? Precisely because of your point, the majority of household income, or at least savings and wealth, is stored in property because of the difficulties, the risks of investing in the equity markets, and of course getting that money offshore. It accounts by some measures, the property sector, for about 20% of China's GDP. And the announcements today, broken by Bloomberg News, around additional measures to support this now beleaguered property sector really speak to the urgency. So they're allowing people to buy more properties in certain cities. They're easing some of those restrictions, making it lower in terms of the down payment you have to put, and in terms of the commissioner fees as well that some of these agents charge. They're putting a cap on those. That's another measure that the government has used to try and put a cap historically on house prices. Now house prices are down. They continue to be lower. That is a major problem for the developers and that economy.
Well, you mentioned the developers. Are they putting in this legislation, and maybe we'll see it, folks, Sunday evening, New York time. Look for our Asian coverage in the Monday morning of Sunday, 7 p.m. New York time. Tom McKenzie, are they doing this for Evergrande? Is the ARC troubled developer, or are they doing this for a couple out to the west in Chengdu looking at pandas?
Well, Wonder and Evergrande are two developers that are firmly in focus, clearly, for policymakers in Beijing. So the total, there's potentially debt default or debt that's at risk that is approximate to about 12% of China's GDP. Property debt that is at risk of default, equivalent to about 12% of Chinese GDP, according to some metrics. And those two developers are in the spotlight, certainly. If they can't shift properties, then the payments that they're making, the inability to tap the markets, and they are paying about 20%, by the way, if they do try and tap the markets, that becomes that much more difficult. If they can't sell properties, they're not buying land. If they're not buying land, then local governments can't fund the support that they need for this economy, because local governments in China, Tom, as you know, depend on land sales in order to drive their revenues to be able to fund the infrastructure projects that Beijing wants to see right now.
Tom, how much is this about supporting the economy and fueling growth, and how much is this just avoiding a massive, massive pitfall?
Well, it's a really fine line to thread. According to Goldman Sachs, total debt, China's total government debt, and that includes the off-balance sheet local government financing vehicles, for example, the shadow banks, it's about $23 trillion. That's the estimate from Goldman Sachs. You're talking, what, 30 trillion in the US for equivalence? So they want to try and engineer that support for the developers. They want to help in terms of the refinancing and access to liquidity. They want to be able to support households and consumers to be able to go out there and have the confidence to buy these properties, because, again, it has that loop back to local governments. But what people are saying as well, the likes of Rhodium Group, are what you really need is a restructuring plan for the debt for these developers, and so far that hasn't been forthcoming. The other point is you're looking again at plus 20% unemployment for China's youth. It is remarkable. That's a record number, and that's the official number. People I speak to on the ground say it's far likely higher than that. That is holding back the demand for property as well. So this cycle is something they're trying to break.
And there's probably a whole lot more to it. Is this the end of stimulus, or is this basically the opening salvo in a series of steps that are expected from the Chinese Communist Party?
I mean, given the fact that we saw Chinese stocks getting close to a bear market earlier this week, that was clearly something that strategists were calling out for, saying, look, you can cut the benchmark rates, you can go through with more reserve requirement ratio cuts for the banking sector. There isn't an inflation problem in China. They do have dry powder, but clearly, and this is something you're nodding to, obviously, Lisa, is the concern, the historic concern that Beijing's policymakers have about getting back to a place where there is over-exuberance in terms of leverage. They've done some work on that front. They don't want to unwind all of it.
Tom, what are you looking for Sunday evening, New York time? Are you like me, where you just say, look, they got to put some news out, and the way to do it is to start the week strong?
out of China, what are we going to be watching? I mean, look, there was an uptick in the equities, of course, today on the back of confidence that maybe you're not going to get the rate hikes coming through from the Fed, that maybe there was a bit of buying because the valuations are looking so cheap in terms of Chinese equities. We'll see if that can be maintained. Those equities listed in Hong Kong. The yuan, as you're saying, seeing a bit of strength. We'll watch for any policy. They are tempted, Chinese policymakers, to push through policy over the weekend. So you're right for that as well. Are they going to come through with any additional supportive measures? Again, this is something that people on the ground are calling out for. People who have exposure to Chinese stocks want to see more support coming through.
Wasn't there a rate cut on Christmas Day a long time ago?
Yes,
do you remember that? How many years ago was that, Tom? It was decades ago, I think.
I would say about a decade ago.
Wow. Tom McKenzie, rate cuts on Christmas, TK.
Yeah.
Gifts for the equity market bulls.
That's what you do. And I mean, McKenzie...
Cut rates on Christmas.
Yeah, you know. Yeah, but the idea is you do it when nobody's looking. I mean, we saw that last Friday. I can't remember what the news item was. Friday, somebody snuck something out, Memorial Day weekend. Nobody will see it. That's what they do.
You've been waiting for this. We've been questioning it. When it comes to policy out of China, I'm not sure they care about the PMI being above 50, below 50.
Yeah.
Tom, what's the long-term goal here? Is it the nervousness around youth unemployment? What is it?
The answer is sitting in Beijing with a pounding headache because of the pollution, doing a conference with BNP Paribas. And I'm sitting there with 500 people in the room, and they've told me, be careful what you say for all the issues. Bloomberg has told me, be careful what you say for all the sensitive reasons. And I'm there with the top thinkers for BNP Paribas with their 100 years of heritage in China. And guess what they said? The PMI doesn't matter.
Yeah.
That's basically what the top bank in France said with all of the emotion of the French district in Shanghai.
Bramo, what do you suppose it is that's pushing China potentially over the line here to do something about property?
Is it just simply because there is so much speculation about a decline? I don't know. I mean, honestly, how much is this a shift that we've seen in terms of CEOs of the U.S. and other places going to China, possibly trying to open up a little bit more because of some of the situations in the economy?
This week, Elon Musk, Jamie Dimon, and Jamie's going where now?
Taiwan.
What do you make of that?
I don't know. 1-800-DIAL-JAMIE when it comes to the political sphere. He's definitely shown his interest in, public office.
You think that's real? We're hearing more and more about that.
I can't imagine that it's not. If he goes to China, has this real neutral tone, and then goes to Taiwan in equal measure, what's this about? Is he looking for chips for JP Morgan?
TK?
I think anything Mr. Dimon does is scrutinized. He could go out for a cup of coffee on Fifth Avenue at the Blue Note Cafe. People would be like, what does it mean?
Well, this comes after our conversation this week with him, and he indicated that he would like to serve his country. Didn't indicate in what capacity.
No, in his annual report, in Lisa's defense, every year there's a theme to the annual report. One year was hard work. Guess what? This year was right where Lisa's talking. It was on geopolitics.
And then Bill Ackman, political expert, came out and talked up the potential of Jamie Dimon running for president.
Not sure that really helped the cause,
I mean,
but I do think that was notable.
if Jamie Dimon was having a cup of coffee with Bill Ackman next to the Guggenheim at the Bluestone Cafe, guess what? It'd make news.
Good cafe, by the way.
Yeah.
Up in the 90s on 5th. Yeah, got a lot of time for that.
Yeah.
Next door to the church.
Yeah, it's usually, I try to get down into the 70s sometime during the weekend, but that's amazing as far as I get.
I'm with you. That's a great place, that
It's
is.
a good place. Yeah.
Sort of like inside the church, to the side.
The avocado's a religious experience.
Nice in the summer, too. Got to get there early, though, to get a seat.
Got to get there early.
Get
Big
there
tourist.
so early.
Yeah, it's on every tourist
Kind of like
bucket
spills
list.
out into the sidewalk, onto the road. And
You ever been to the Guggenheim?
no,
Oh, you should go.
walk past it a lot.
It's got a real soul.
Has it?
Yes.
Doesn't look like it's got one.
It's got a soul.
All right, I'll check it out. Future's Positive from New York. This is Bloomberg.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of a family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The economy really hasn't slowed much at all.
We had the Q1 earnings results. Corporate America's actually doing all right.
This is a recession postponed, not canceled.
Even if we have a mild recession, I would still cast that as potentially a soft landing sort of scenario.
We've learned that you have to be cautious. I think we've learned that you have to be tactical in this market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Looking to get you to the weekend, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive by 0.5% on the S&P 500. Payrolls 90 minutes away. In our Bloomberg survey, the estimate 195,000. Lots of talks about the potential for stimulus out of China. Our latest reporting, TK, indicating under consideration, weighing options around the property market.
A set of good news is life goes on a Friday morning. We wake up to the Senate solution in Washington. We wake up to the maybe Beijing solution in China. Are we going to wake up to a jobs report that changes Fed policy going to June 14th? Frankly, either way, I'm not sure which way it'll cut in the jobs report.
I think Lisa's been nailing this after the Fed speak of this week so far, Lisa. Have they de-emphasized the importance of this payrolls print, just with regards to what they do and don't do in June?
It seems like they want to pause, skip, whatever you want to call it, and it's not really going to make a difference unless there's some sort of blowout number. Of course, we're going to be saying something completely different probably at 8:30 a.m. today. If we do get something different, it's a tough moment when there is so much conflicting data, and this is something that a lot of traders are having trouble with.
CPI after this one as well. I do wonder, Andrew Honhorst, the City, we've talked about him a few times. He said 200K, 0.4% core CPI, maybe at the start of the week, Bramo. Now, after Governor Jefferson, after President Harker?
How can you push back against them saying, we're going to skip?
Tough,
we think it
isn't
makes sense. I mean, so he's joining the crowd and kind of...
Well, I like what Sarah Howe said with Wells Fargo. She said, look at the 3 months moving average. How do they pause skip if the 3 months moving average, which to me is good math, lifts up? I don't know where that statistic is, but, you know, the data's the data. I'm sorry.
The cumulative tightening of the last 12 months plus. We want to look around a little bit more and See the damage done? It's been a week of contradictions. We've talked about that a few times. If you look at the labour market data in America, it looks stellar, looks decent, looks great. Look at manufacturing. Manufacturing worldwide, Lisa, it's screaming recession right now. We're not talking about the prospect of China stimulus because things are good. It's because manufacturing in Europe, in China, in the United States is flat out bad.
Is there any corollary to this rolling recession in specific sectors? How do you sort of make sense of the recession that you're seeing in manufacturing if it isn't bleeding into the services sector? There's going to be a real question about how much weakness there really is in other areas, whether it's filtering in or whether it will rebound before that happens.
End of 2015, we had this conversation around a manufacturing recession in China. Tom, do you remember?
Yeah.
We escaped things in the United States and we continued the expansion.
I think this, you know where I am on, John. You're busting my chops here. The aggregation of economic data, the aggregation of market data is hazardous to your pocketbook. Can I note a VIX 15.42, SPX rounded up 4,300 at 42.50? To me, John, it's just about equity markets adjusting to how well America's doing versus everyone else.
And equities are up right now by 0.5%. Let's go through the price action. Futures positive, yields a little bit higher by a single basis point. The euro trying to find some strength and struggling, just about positive on that currency pair. The euro against the dollar, 107.68. And crude up, as you might expect, Lisa, up 1.5%, 71.14.
For now, and we're going to talk to our next guest who probably would fade the China stimulus argument, which I think will be interesting to discuss. At 8:30 a.m., we do get the May payrolls report. There have been 13 straight months of upside surprises. What happens if that gets broken? What happens if it doesn't? How does this get parsed out at a time when the unemployment rate is still historically low and the Fed would like to see a little bit of loosening in that market? Today, JP Morgan COO Dan Pinto and Citi CEO Jane Fraser are among speakers at the Bernstein conference. Very curious to see whether they had that changed tone that we heard from Goldman Sachs' John Waldron yesterday about a greater degree of caution and possible declines in trading volumes and trading revenues. And this weekend, the OPEC Plus meeting in Vienna on Saturday and Sunday. Production cuts, agreement among the constituents. What message are they trying to get across at a time when oil isn't that low historically? And somehow this is catastrophic for Saudi Arabia. They want to get the prices up and they want to jawbone it up, and they're going to disinvite certain journalists as a response.
So to be clear, this is an OPEC Plus meeting, like Russia will be there?
The plus indicates
the
so,
plus, yeah, okay.
Yeah.
That's different than the cartel, isn't it?
Well, it's been that way for a while now, hasn't it?
Yeah, for their 8-minute meetings. Are we assuming a longer minute meeting now? That's where Powell got the idea for the Jackson Hole speech.
Is that right? From OPEC
First,
Plus?
create no harm.
We're going to hike 100 basis points.
Yeah.
And then move on. Within Global Head of Currency Strategy at Brown Brothers, Harriman joins us now. We're wonderful to catch up with you, sir. Payroll's about 85 minutes away or so. When have you got an idea of how big that number needs to be to reintroduce the prospect of a rate hike this month?
First of all, thanks. It's always a pleasure to appear with you guys. So thanks for having me. Look, to Lisa's point, it's strange to me that the Fed is talking about a skip, at least some of the officials, because in the past, they've been saying it's data dependent. Well, if it's data dependent, how can you pre-commit to a skip? So I find it very puzzling. I think they may, end up regretting painting themselves into such a corner, because if you look at the JOLTS data, you look at the ADP data, it looks like we're going to get an upside surprise. Consensus is 195K. Probably something 250, north of 250K would really get the Fed's attention. Obviously, as you point out, there's also CPI and PPI data out later in the month. It should be data dependent. And to see the Fed sort of pre-commit to a skip, it's very puzzling. It's another one of those communication problems that I think the Fed has been plagued with from time to time.
But what does data dependent mean right now, when you can make an argument, any argument you want from the data that we have?
Yes, absolutely. But I think really what they are looking at is the jobs data and the CPI data, and to a lesser extent, obviously PCE as well. Those are really the big three. The PPI is not so important because there's a whole question of whether firms can pass through to the consumer, et cetera, et cetera. But really, it's unfortunate that the Fed, look, for every central bank is struggling with the same issue, right? Elevated inflation, team transitory lost big time, and they're really trying to catch up. I think a lot of the policymakers on the Fed are starting to get nervous because they've come so far so fast. But to me, it's like if you're going to do it, just get it over with. Right. Why skip a month? Just get it over with. Let's see where the end ends up. I'm sorry. Go ahead.
No, Dr. Thin, from your time at Columbia, and with your heritage of Burma and north across the Pacific Rim to Japan, you've owned the high ground on analysis of China. What a bombshell this morning as Bloomberg reports, guess what? They're going to do stimulus. This time around, what is the desperation in Beijing to provide a stimulus to China? And quite frankly, after your South Korea report, the rest of the Pacific Rim?
Yeah, so Tom, that's really China's been a puzzle, right? We had the big champagne celebration back in December when the reopening was announced. Everyone was, ready to have a big boost to global growth, but that simply hasn't materialized. And that's part of the reason is that China's turned much more inward, right? And that's for a variety of reasons. But we know that under President Xi, in his third term, it's going to be much more domestically focused. So we haven't seen any impact really on the regional exports, Korean exports, Taiwan export orders, Japan, Germany, all really still weak. So there's no global growth bullet from China. To me, what's worrisome is that they're falling back on basically pumping air back into a property bubble that was already deflating. It's a default setting that they have. And I think it's each time it's marginally less effective and becomes marginally more dangerous.
Right.
It's a muddle-through approach, but I think look, we know all the stories about the ghost cities and unused apartment buildings and et cetera, et cetera. And this isn't going to help. So I remain pretty negative on China. I think I think markets got really got overly bullish on the China story.
Will they export disinflation to the United States?
Well, that's obviously the risk. I think the CPI, PPI out next week. The PPI is already in deflationary territory for the mainland, and CPI is something like 0.3, 0.2%. So in a world of high inflation, that's actually not a bad thing. So, unintentionally or not, China may end up helping the global economy through that channel rather than really through the growth channel. But either way, the days of China growing, even 5, 6, 7% are really over. I think they'll be lucky if they have a floor handle. And it's part of the maturing of an emerging market economy. But the inward-looking focus of China is certainly, I think, a real game changer for emerging markets as a whole, for commodities, really for the global economy. And we're just seeing the beginning of that.
You're raising such an important question, Win. It really questions whether equities should be up outside of China off the back of reporting like this morning. Is that what you're suggesting?
Yeah, absolutely. And look, we look at coal prices, iron ore prices, oil prices, and the fact that OPEC is talking about probably contemplating another output cut, despite the China reopening, just tells us that really the global impact has been really limited. It just hasn't really shown up in any of the sort of tea leaves that one looks at. So, look, global growth is slowing this year. We're not going to see really monetary policies being tightened around the world. But to me, the global recovery story is really a 2024 story if we're lucky. And we haven't even seen the U.S. recession yet.
Yeah,
that's coming. That's coming. I have no doubt about it. The timing is obviously the question, but the good news is it's a Fed-induced, policy-induced recession. It's not a global financial crisis. It's not a pandemic.
Right.
We're back to normal, right? It's sort of a normal business cycle. But right now, we're in the sort of the bad part of the cycle.
Win Thin of Brown Brothers Harriman. Win, thank you, sir. I think Mike McKee said it yesterday. Every year for the last however many years, we've been talking about a recession in the next 3 months, right? We've been doing that all year. Did it all last year. 3 months away.
Yeah, 18
Lisa, 3 months away.
Yeah, 18 months.
3 months away. Yeah. Is it 3 months away?
Who knows? How does anyone have an edge on saying that it is going to be or isn't going to be? And this is really the trick.
Well,
so how do you really interpret data that's come in surprising, that hasn't really confirmed recession? Maybe it's slowing down. What are we talking about even with hard landing and soft landing, which people have been debating for 12 months?
I've been
no landing. Yeah. What's that?
To me, it's the politicians do this better. It's not about a recession. It's half of America's flat on their back, and a quarter of America's prospering, et cetera. But I have trouble with the certitude of an NBER recession definition. Where, John, you get half of 1% real GDP growth. That's going to feel like a recession to a lot of people.
If you're hanging out, no one in this market is waiting for a group of economists to get together and look back at the last year and say, that was it, Lisa, that was it. If you want a quote that captures exactly what you just said about half of America being flat on its back, the Dollar General CEO, our customers are saying they're having to rely more on food banks, savings, credit cards. Torsten Slock of Apollo yesterday, Lisa, I know you looked at the same chart because we read the same stuff. Delinquency rates, credit cards, not moving in the right direction.
I don't read anything.
We saw something similar from Macy's. This is a serious issue for a lot of people. And so at what point does this become broader?
You stopped reading a long time ago. I'll tell you all a story one day about a guest. Tom and I anchoring out of London and a guest coming on set. In fact, I'll share it now. I've got 20 seconds. Comes on set, it's got a new book, right? Book's just come out. TK quickly flicks through it, picks a chapter a page. I was reading this last night, never read it before. The guest, should have seen the guest's face, just lights up thinking TK's read his book. He never read it. Nadia Lovely, UBS, coming up in the next hour.
I read Nadia's research. We're going to do it on the break. We're going to do it on the break, John, please. Yes, Amy, I'll read Nadia's research, please.
Gotta love that. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. China's ambassador Li Wei says it would be difficult for Russia and Ukraine to currently hold meaningful talks to end their conflict as Beijing tries to broker a peace deal. Li has been tasked with promoting Beijing's efforts to negotiate an end to Russia's war in Ukraine, part of a wider blueprint spearheaded by President Xi Jinping, Russia's biggest diplomatic backer. In Singapore, Pentagon Chief Lloyd Austin and his Chinese counterpart Li Shangfu are among more than 600 military leaders, policymakers, and analysts from 40 nations taking part in the annual Shangri-La Dialogue. Now, the U.S. says Beijing has ruled out a meeting between the two military chiefs. With China frustrated, the Biden administration hasn't removed sanctions the U.S. placed on Li in 2018. The CEO of Palantir says new AI developments are so powerful that he isn't sure they should even be offered to some customers. Speaking exclusively to Bloomberg, Alex Karp says he's wary about providing the tools to local law enforcement agencies for purposes such as surveillance.
Usually we have to go out and find people. Now we have customers, especially in the U.S., just calling us every day.
You said the demand is huge. Yeah. Can you quantify it in some way?
Well, you know, usually, we've had a number of inbound calls in a year.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. So far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jake Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May jobs report, today on Bloomberg Television and Radio.
This demanded a bipartisan solution. We knew we'd need to come together for a solution like the one that passed tonight. And so I'm happy to stand here passing this critical legislation to support our families, preserve vital programs, and most importantly, avoid catastrophic default.
And pass it did, 63 to 36. Senate Majority Leader Chuck Schumer there weighing in on the passing of that bill. The President of the United States weighing in as well. No one gets everything they want in a negotiation, but make no mistake about it, this bipartisan agreement is a big win for our economy and the American people. The President addressing the American people, addressing the nation a little bit later on this evening, and then we can leave this drama behind, Tom.
Oh, that's a really
hopefully
good
move
insight.
on.
Are we leaving this drama behind? I mean, we're going to talk to Anne-Marie here in a second. I guess she'll drive it forward. But the answer is there's follow-on agreements, as we talked about yesterday, where they have controlled spending or it all falls apart down the road. I wonder how far down the road is.
Speaker McCarthy, big win. Got to reflect on that.
Yes.
Big win. Considering where he was, 15 votes it took to become Speaker. 15. And we were doubting how long he could hold on. Managed to pass a bill through the House. Managed to do it again, Lisa. Managed to come to an agreement with the President, who said he was not going to negotiate over the debt ceiling, and then did. Is he in better standing with the country? Possibly. With his party? Remains to be seen.
They're still talking about possibly putting in a vote to remove him. I have to wonder whether they almost have to basically show, oh, we're not happy with some agreement because it kind of violated things, but they're not going to actually oust him. And if they forgot, if for some reason they did, Democrats would come to his rescue.
What's amazing about the sitting president as well is that he talked about uniting the country, and he's managed to do some things on a bipartisan basis. But then at the same time, simultaneously, has managed to ostracize big chunks of the country as well. And hasn't done anything to unite the country, Tom. It's kind of amazing. If you look at substance and certain bills that he's managed to pass with the help of people on the other side of the aisle, there's a plenty to talk about there on the campaign trail. But for a lot of people, if you ask them about the optics, who this president represents, I think a lot of Republicans, Tom, would say,
totally agree.
Not us.
Well, it's the modern convention. I mean, Roger Ailes invented this at Fox, and it's something people clearly like to talk about on both sides of the aisle, and it's led to a visible, almost entertainment polarity here. Is the same equivalency in the United Kingdom? I don't think so. My distant view is it's just not as frenzied on the far left, far right in other countries.
Becoming more that
here.
way. I think it's becoming more that way.
Okay.
More recently over the last few years.
Let's get to it. And this is, of course, on a Friday that has changed. Anne-Marie Horton is our Bloomberg change agent in Washington, putting together Balance of Power with Joe Matthew this evening as well. Is it over, Anne-Marie, or is there debris after this that you have to study, that you have to report on?
Well, the debt limit crisis is over in the sense that we will not have this default. The president will be speaking this evening. I think it's notable he's speaking tonight because he has, for the most part, really tried to remain silent in terms of the fact that if you look at him versus Speaker McCarthy, who was giving a gaggle, which felt like every 15 or 20 minutes with reporters, this is the president's moment to say and why he thinks actually his negotiating team can claim victory. The debris that you need to watch now, of course, is how Speaker McCarthy really just navigates the rest of the year and the infighting within his own party. He got 2/3 of Republicans to vote for this, but still, when you look at the numbers, more Democrats voted for this bill in the House than Republicans. And at the same time, you do have members on the far right, some of them wanting to have a vote, potentially call for his removal, a vote of no confidence, a motion of no confidence for him. At this moment, I think it's overblown, but potentially if other issues arise that these individuals do not agree with him on, you could potentially see this being used as leverage against him.
MH, this is a president that surely just goes into campaign mode now. They're not going to do anything else, are they?
Well, of course, this deal means they also have to make sure they're setting appropriations. So there's going to be another big fight as we head towards October 1st. And I think what was really interesting yesterday was Senator Schumer's comments in the Senate, really trying to assuage senators' concerns about the fact that there could be these carve-outs, these supplementals, call it what you need it be for emergency need of funds, whether that's fentanyl crisis domestically, whether or not that's defense for Ukraine, because many of the Republican defense hawks did not think this deal went far enough when it came to the defense budget. So there's going to be other issues, but you're right, Jonathan. We are a little bit more than 500 days out from the next election cycle. And it's a divided government, so President Biden will be looking to see how he shores up those votes as we go into 2024.
When you talk about the divisions in the Republican Party, I am curious about some of the divisions that were really made evident in the Democratic Party. The Joe Manchin versus Tim Kaine battle was fascinating, where basically Tim Kaine introduced an amendment to strip out the pipeline provisions and in permitting process for Joe Manchin. What do you make of this, not with respect to just the debt ceiling debate, but also going forward, how this really represents the polarities of the Democratic Party?
Well, I think this was on full display during the president's first year when he was trying to get through Build Back Better. It really was Joe Manchin versus the White House. When it comes to this specific pipeline, what Senator Kaine took issue with is that this was included in the debt ceiling bill, which he didn't understand why, and it affects his state of Virginia. So he wanted this amendment to strip it out, and he had a lot of harsh criticism for the White House regarding this. But the White House will tell you this bill, this pipeline was always going to happen, so we were allowed to have it come in. I think whether or not you look on the left or the right, there's obvious divisions within the party. I think what this bill does show is a president that had to move to the center to get something done, and he had to sit down with Speaker McCarthy to make sure that there was no default and give in on some issues.
Emery, quickly here, the president's going to step up to a podium tonight at 7 p.m., and you know he's going to make a joke about looking for sandbags on the floor. John mentioned this earlier. We're so sensitive to both Mr. Biden and Mr. Trump falling down, whatever, the whole age thing as well. Does this thing go away by Saturday morning, 10 a.m. when I'm watching Manchester United and Manchester City, or does this thing have legs? Worry about falling down.
I think potentially you can see this go into the Sunday shows. I think it's less about the president falling. I think it's more about the concerns of what that means. Early on this month, the ABC Washington Post poll had about 70% of Americans thought that the president was just too old to have another term. So when you see him falling, it is those types of headlines that obviously are concerning for the Democratic Party. He's falling. He's a much older president, and yet he wants another 4 years.
MH, thank you. The latest down in Washington, D.C. and beyond. This should be in a pub quiz. Who was Hillary Clinton's running mate in 2016? That should be in a pub quiz. Tim Kaine.
Oh, that's right.
Can you think of anyone more vanilla?
I honestly couldn't remember. I am embarrassed to say.
It's a nice guy. It's fun.
Just that's it. A nice guy. A nice guy.
10 a.m. tomorrow morning. Manchester City.
Yeah.
John, I mean, am I right to say it's like a nationwide baseball tournament and then the Yankees play the Mets? I mean, is that the equivalent? The FA thing is a United Kingdom
It's
thing?
a very old cup competition, but it goes all the way down to the lower leagues. So anyone can ultimately end up in the final. So you end up with situations sometimes where you have really big clubs, Manchester City playing really small teams in really small stadiums, and those small clubs get TV money. It's very cool still.
Will the nation be riveted by the red and blue of Manchester playing? Like, do they play their best players? They'll
play their best players. It's important. So Manchester City's going through the treble, the league title, the
Premier
FA Cup,
League,
the Champions League.
Very cool.
So Manchester United get the opportunity to stop them and disrupt them from winning everything this year.
But my childhood is Man U is like the Yankees.
That's the heritage, sure.
Kingdom.
And now Man City's got the money.
Man City's got the money, and they've really taken over the generational thing
in a big way.
Yeah,
they're the winners right now. They're dominating. They've got the
fun
money. They've got the players.
When I watch them as a complete amateur, there's absolutely no weak players on the field.
That's because they've spent a huge amount of money, massive. Bramo follows this now too.
Oh, yeah.
There's like an asterisk next to everything Manchester City do because opposing fans are like, yes, but they bought it.
Exactly, and it's not as good, right?
And they
Are you going to watch this tomorrow at 10 a.m.? Is this like a big enough deal to...
It's Spanish Grand Prix tomorrow, qualifying.
The qualies are tomorrow?
Qualies tomorrow morning.
They took the chicane out.
big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Payrolls report 60 minutes away. Jobs just around the corner. We're told it's National Donut Day, but we're more serious here. We talk about things you care about, like the economic data and the Federal Reserve, so let's do that now. Equity futures on the S&P 500.
Please bring them over here right now.
Chocolate color.
Positive, up 0.6%. Just pretending to be business TV, you know. Over on the NASDAQ, up by 0.6% as well. Equities up. Yields look like this in a bond market. 2-year, 10-year, 30-year. 2-year yield actually down on the week. Governor Jefferson just poured ice-cold water over any meaning to the economic data whatsoever. I'm looking forward to the conversation we'll have with Morgan Stanley in a moment on that. But, Lisa, that seems to be the takeaway from a lot of people. That speech, that address, call it what you will, just really de-emphasized the incoming information going into the quiet period.
I totally agree, especially if we get data today that is an upside surprise. How can they turn around and say, actually, now we can't wait? How do they then say, well, actually, now it doesn't make sense to skip? We actually have enough to think that there is some sort of runaway inflation or runaway power in the economy that we didn't know a day earlier. It makes it very difficult for them on a messaging level. Data dependent, except we're not dependent on this data. We're dependent on all the other data and all the other information that comes in between now and July, which is why we went on this rant. I went on this rant around the last Federal Reserve decision. Data dependence is absolutely meaningless. You can attach whatever meaning you want to it whenever you want and change it whenever you fancy, which is what these Federal Reserve officials do. When they don't want to answer the question, I always sit in front of them. They're very polite individuals. You do too. We all do. When they don't want to answer the question, they say, we are data dependent. We will be data dependent. But, you know, what does that actually mean? It means they don't know what to do right now. Sure. And I think that's really the bottom line. They don't know what to do. And as investors, you can't really rely on the Fed to give answers in the same kind of way that they did during the era of financial repression. That's upending a lot of the traditional trading strategies that grew up in the past 15 years. So we skip. So we skip. Let's skip to this in foreign exchange. There is talk of stimulus, a package, potentially. Our reporting suggesting that a package of stimulus measures, supportive measures of the property market in China is being considered. That means you've got a stronger Chinese currency this morning. Lifting commodities as well, but I have to say this is really marginal stuff. If you look at copper, gone are the days where you'd hear China's stimulus and copper was up like 2, 3, 4, 5%. Copper this morning, Tom, up by 1%. Not a big move. Crude up by 1%. Not a big move.
We don't have time here because we've got an important guest, but just as simple as that, the correlations on my screen melt up. I don't know if we're going to get that. That's what it looks like.
Crude 71.30 this morning.
Well, there certainly is a melt up in certain shares, particularly Lululemon. We talked about it yesterday. It did come out after the bell.
You nailed it. The first thing I looked at today.
All I can say is it's really interesting to see the shares up more than 15%. They reported net revenue in the first quarter that beat estimates. They talked about strength Talk about the K-shaped recovery and the difference between the Macy's and the Dollar Generals of the world, and then Lululemon, where you buy a pair of stretch pants for more than $100, and that those things are flying off the shelves, particularly in China. It gives a sense of who has discretionary spending and who doesn't. Broadcom, shares are lower by 0.7% after reporting earnings. They even tried to bolster their valuation by saying AI, but AI, and it didn't work. It did for a hot second, but then they went down because they just have a broader issue on their hands of waning demand for certain legacy chips. And Dell shares are lower by more than 3%, despite beating analyst estimates. Again, they're the winners and the losers of this moment. If you mention AI and have the chops to back it up, you win. If you don't, and you're kind of depending on a PC business that is sort of tepid right now, it's going to be a hard sell.
I'm pleased you brought up Lulu. You mentioned it yesterday as an important thing for us to look for.
Yeah.
Lulu was okay. Nordstrom is hanging on. Then you look at the lower end of stuff. Dollar General, just brutal. I mean, really, really brutal. The commentary on their consumer, their customer, did not paint a pretty picture of this U.S. economy at all, which is going to fly in the face of what we hear this week about the labour market. I've got no idea what this number looks like in an hour, but you look back at claims, vacancies, the ADP report, all those top-line numbers say things are okay in the labour market. Then you hear that commentary from Dollar General, Tom. It just sounds terrible out there for their customers.
And the bifurcation at Macy's between Bloomingdale's, not bad at all. Dana Telsey reporting that. And then Macy's challenge. She lowered her price target for Macy's yesterday.
Looking ahead, Tom, to payrolls about an hour from now or so. We're looking for 195,000 jobs. Unemployment's come higher to about 3.5% or so from 3.4. Sarah Wolf and a team at Morgan Stanley coming in at the low end, looking for about 170,000 jobs. And unemployment, Tom, to stick at 3.4%.
And the heritage of Morgan Stanley Economics and all the work of Ellen Zentner on consumption following along with great strength as their senior economist, Sarah Wolf, joining us this morning. You are consumer focused. Is the consumer on the edge of recession?
I don't think the consumer's on the edge of recession. I think that we're definitely seeing weak spots. The lower end consumer maybe has been recessionary for the past year. Middle, higher income consumers still doing okay. We're seeing some notes of trade down, that discretionary is starting to pull back. But we're in a weaker economy today than we were last year. There's less pent up demand. There's less savings. Why would discretionary spending still be so strong?
John mentions your below 200,000 statistic that we're going to see at 8:30 today. What number do you need to see equating into a 3-month moving average for non-farm payrolls, which changes the Fed from pause, skip silliness to lifting rates?
Listen, the bar is much higher now post-Jefferson. You guys said it. I think that there was a lot more focus earlier on the week on payrolls, and now Jefferson squashed a lot of that.
Give me a number.
All right, I'll give you a number. I'll give you a number. I think if we saw 2 months of an acceleration in payroll, so if we're getting 250 or above today with no downward revisions to last month, that's 2-month acceleration. I think that that puts some concern, of course, that jobs are re-accelerating, but still bar very high.
What's more important, the jobs number or payrolls growth?
You know, it's going to matter where we are on the 3-month moving average. I think that's what the Fed's watching very closely. With our forecast, 3-month moving average is coming down from about 220,000 to 196. So smoothing that out, there's still some room for an upside surprise on our 170K number and still have the 3-month moving average coming down. I want to make one more really important point. Sure. 5 out of the last 6 years, April gets revised down with the May payroll report. So I think that that's...
Why is that?
So part of it is the seasonal hurdle. There's a higher seasonal hurdle. So typically that causes some downward revision, but it's also the fact that the seasonal hurdle this past last month was about 640,000. Typically it's 800,000. So if we were to see some adjustment to historical seasonals, that would mean a lower print on April. So I think that's going to be really important to watch, similar to last month where we got 250 on headline, but massive downward revisions to the 2 months prior, and so market pricing didn't move too much off the report.
I'm always interested, Sarah, in how the conversation changes just compared to where we are now, compared to where we were maybe a couple of months ago. A couple of months ago, we were talking about communicating a pause and trying to figure out how high the bar was for cuts. And now we're here talking about a skip and discussing how high the bar is for more hikes. What's changed in the last month or so?
I think we've got some weaker data that's come in. I mean, you saw the beige book that came out yesterday. I thought that was a pretty soft beige book. They basically said...
I thought the same thing, too.
Yeah. Economic activity.
He doesn't read the beige book.
You don't read the beige book?
He's never read the beige book.
In honor of the late Richie Amarone at Bloomberg, I did not read the beige book.
Well, I read it top to bottom.
Thank you.
And it was interesting.
That's why you're here, Sarah.
Thank you for having me. It was softer. It basically said economic activities little changed. That's in line with our GDP tracking, which is basically 0% growth for the second quarter. There was notes that there's consumer trade down, there's less ability for businesses to push through pricing power, that there's a pullback in discretionary. So there's definitely elements of weakness that we're seeing coming through the data, and I think that's been reflected in some of the Fed speak as well.
Have we killed off the fears of runaway inflation? Is that basically the tail risk that's almost been taken off the table over the past couple of months?
I don't think it's been fully taken off the table, but I think that people are finally realizing that just the way that inflation was surprising to the upside constantly on the way up, we could also see it come down the same way. And I think that the labor market data, but also what we're seeing on new orders for ISM manufacturing coming down, prices paid in ISM manufacturing coming down, all these are good indicators that goods deflation is going to continue well underway.
We were talking with Bob Michael of JP Morgan Asset Management, and he was saying he expects a real rapid disinflation later in this year, outright deflation in certain segments, particularly in the goods sectors. Do you agree? Do you think that what we've seen over the past few months, particularly with wages as well, which have slowed down, do you also expect a much faster rate of disinflation than you previously thought earlier in the year?
Definitely. I mean, we have the labor market slowing pretty substantially in the coming months. We're getting down to about 40,000 jobs at the low, and we already hit that in August. So we're only a couple months away from that, and that's going to help bring wages down with it, less churn, and that's that lead through into core services disinflation. So that definitely accelerates back half of the year, and all the leading indicators are pointing to more broad-based deflation in core goods, even outside of used vehicle prices.
Just to be clear, do you think that we can get to 4.5% unemployment by year end?
No, we are much below consensus. We're about 4.1% by the end of the year, and I think the Fed's going to have to mark their summary of economic projections in June lower. 4.5% is going to be really hard to achieve. We're at 3.4%, and we're halfway through the year. You'd have to see some big negative job prints, not big, but moderate negative job prints to get to 4.5%.
This is what's going to be interesting about the June meeting. How are they going to reconcile not hiking with a shift in their projections that may well suggest that they should be hiking?
Inflation's coming in along with expectations, so I don't think they need to touch inflation. I don't think they need to touch their economic projections on GDP. I think what the lower unemployment rate says is that they're actually able to reach their target without hurting the labor market more, which was in line with Powell's original commentary that we could get job openings to come down, hiring to come down without layoffs to rise. Maybe it's even better than what they expected and more in line with actually our forecasts.
What I feel like they're communicating right now is we can skip June and consider July. Will that be implied in the dot plot, given that the previous round was a dot that is essentially where we are right now?
No, I don't think that they're going to move the dot plot. Of course, it's data dependent, so anything could happen in the next couple of months, kind of data dependent. But at this point, with inflation coming in line with their expectations, there's no reason for them to change the dot plot. Why would they do that?
Sarah Wolf of Morgan Stanley. Sarah, thank you.
Thanks for
having me. There will be some people later satisfied with where the rates are at and others who still want to go higher.
Well, and it raises this question, if unemployment isn't taking the hit they expected, but inflation is coming down, can they celebrate victory, or are they not quashing things enough, and are they leaving things too sticky? But yeah, that's exactly to your point. Do people go further and want to see more destruction in a labor market when that's against their mandate, their other part of their mandate?
I'm really looking forward to his speech in August, you know.
I agree.
Jackson Hole. We'll be there in Wyoming, and we can sort of bookend the two speeches and compare and contrast what he said 12 months before. Pain. Where's unemployment going to be when he sits there in August?
Agree.
3 handle still?
3.5%.
That's a 3 handle still. Can you imagine?
To Sarah's comments, late August will be really, really interesting.
Randy Krosner, former Fed governor, joining us, I believe, around the table in about 30 minutes' time. So that'll be cool. We'll catch up with him just ahead of payrolls, about 48 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China's Ambassador Li Wei says it would be difficult for Russia and Ukraine to currently hold meaningful talks to end their conflict as Beijing tries to broker a peace deal. Li has been tasked with promoting Beijing's efforts to negotiate an end to Russia's war in Ukraine, part of a wider blueprint spearheaded by President Xi Jinping, Russia's biggest diplomatic backer. Bloomberg has learned Turkish President Recep Tayyip Erdogan will tap Mehmet Şimşek as his new Treasury and Finance Minister. Şimşek is an advocate of conventional economics. Supporters say his appointment will likely shore up market confidence. Şimşek is said to be in charge of all of Turkey's economic policies in the new cabinet. Erdogan won re-election on Sunday, extending his more than 2 decades in power. Netflix shareholders voted to reject pay packages for the company's leadership, including co-chief executive officers Ted Sarandos and Greg Peters. Now, Sarandos is supposed to make as much as $40 million between his salary, bonus, and stock options, while Peters is supposed to make $34.6 million. Netflix's board can disregard the results, though the vote is significant given the current tension between the major Hollywood studios and screenwriters. And the Pentagon is set to buy Starlink satellite communications terminals from services from Elon Musk's SpaceX for use by the Ukrainian military. The U.S. has praised the role that the terminals have played in Kyiv's war effort, seeing them as vital for the country's defense. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
They're going to take a pause because they believe that there are long and vertical legs of monetary policy, and so they want to see the effects of prior actions. But they've characterized it as a skip because they think that they'll probably have to do a little bit more. And we'll probably see that in the summary of economic projections. We'll probably see a couple, 1 or 2 additional rate hikes penciled in for 2023.
Bill Dudley there, the former New York Fed president, a Bloomberg opinion columnist, just distracted by a tweet. Thank you for writing in, everyone, as always. I think you need to have a Bloomberg TV summer educational road trip to London HQ for a few months so Tom can immerse himself in all things British. Do Ascot, Henley, Wimbledon, get him a top hat, take him into the city of London to discover, do you Brits still call corn wheat?
No, but this is important.
Or wheat corn.
National Donut Day, the Death Stars. Andrew Ross Sorkin's eaten like 5 donuts this morning. It's embarrassing. And John, you taught me this.
What's that?
Greg's Sausage.
Sausage
I'm
rolls.
at Jubilee Station, I think it's called, down below. And we should, when in London, we should have Greg's Sausage Roll Day.
You want to go over there just to have sausage roll day?
Just to have sausage roll day. Lisa, they're phenomenal. they're like they got to be more nutritious than a damn donut, right?
I'm not sure about that. Not sure about that at all. If you are just tuning in, it's a serious conversation about payrolls.
Yes,
That's what we're doing this morning.
Within an hour.
We're about 43 minutes away from the payrolls report. This is the state of things going into it. Equities with a lift on the S&P 500, encouraged by some reporting here at Bloomberg that maybe you get a package of support from China for the property market over there. Property developers overnight in China rallying, the Chinese currency rallying, bit of a rally in commodities as well, crude up by 1.6%. Not a big one, though, up to $71.21. If you'd like to know where the bond market is, I can tell you where the 10-year is right now. The 10-year at the moment is around about 360 at 359.70.
3-month 10-year spread is one thing that sticks out today, negative 100 basis points, and that's where that Treasury yield, 3-month T-bill, still elevated versus that 10-year yield. Other than that, it's pretty quiescent, but John, I go back to a VIX of 15.45. Nobody's talking about it.
I'm looking at the 2-year down 20 basis points this week. What's interesting about that move, it's not about the data at all. Data's been pretty good, with the exception of the ISM manufacturing. You look at the labour market stuff we've had this week, claims, jolts, job openings, vacancies, small wrinkle, of course, the quits rate. You look at the ADP report, big move higher there as well. It's not about the data. It goes back to something Sarah Wolf from Morgan Stanley was talking about, something Lisa mentioned a few times, something we've had a discussion about. Governor Jefferson, presumed future Fed vice chair, just pouring cold water over any meaning in this payrolls report this morning for the June decision.
They need to wait. They need to see more data. 1 month is not going to really shake the tree that much. And so at some point, how much do we really see any kind of upside surprise that could really materially shift their thinking? That said, what we were just hearing from Sarah Wolf of Morgan Stanley, the revisions to the prior months, that will be much more interesting than I previously had imagined.
The revisions, I slam it into a 90-day moving average, 3-month moving average to smooth things out. This is a trap now at 7:49 coming up here on 40 Minutes of the Jobs Report. Because of Anna Wong, the chief U.S. economist for Bloomberg Economics, it's just simple. We can have 100% Fed chat because she's been so right about monetary policy in the United States. We digress this morning to the state of the American labor economy. Do you aggregate when you look at the labor economy, Dr. Wong, or do you look at parts of the labor economy, some really quite strong and others screaming recession?
Yeah, we look at we look at the labor market from a firm size perspective, from different states' perspective. For example, we looked at whether which states are currently in recession right now, and we found that about 30% of the U.S. Population is currently living in states that are that fulfill the Psalms rule, which is a identification for concurrent occurrence of recession. We also looked at small firms versus large firms, and that's where things are interesting because large firms are the places that's laying off workers that are dominating news headlines. But small firms, they were not able to hire as many workers during the pandemic. Right. But even they, I think we have seen that even they are dropping their hiring plans and starting to lay off or freeze hiring.
Do we have a clear picture of the technology overlay on the American job economy, on our labor economy? I would guess it's going to take 10, 20, 30 years for people like Luigi Zingales to actually figure out what the technology overlay is.
Yeah, I mean, recently I've looked at some interesting data on reasons for laying off workers. And actually AI, some employers are already referencing AI as a reason for laying off workers. So I think the power of AI could lead to even accelerated layoffs for white-collar workers who actually during the pandemic benefited a lot from all these, remote from home working, and they're even more susceptible from being laid off because of AI going forward.
Do you think that it's probable that the unemployment rate rises to 4.5% by the end of this year? Do you think that it's going to rise more slowly, or do you think that there's going to be a seismic jump that perhaps isn't as linear as some of the recent progressions have shown?
Yeah, we looked exactly into this issue, and it's actually possible. So if a recession began in the summer, say July or August, we looked at the historical progression of non-farm payrolls, and it actually is entirely possible to see an unemployment rate going to 4.4 or 4.5%. That is conditional if a recession happens during the summer, starting in the summer.
Why is it that different states have such different backdrops? How does this sort of affect national policy if these specific regions are facing incredibly different economic realities?
Yeah, I think in the past recessions, usually all these bad things happen all at once. But in the current economy, we have a tech recession, we have a manufacturing recession, and if you look at the states, so obviously California would be affected by this, tech recession, but also, so I think that what we are experiencing right now is some sort of rolling recessions where you first have some states who are hit first. So the big question is whether the other states, which are, for example, states which have a more diverse industry base, equal in tech, finance, or manufacturing or non-manufacturing, those states are doing well. And the question is whether those states would fall into recession as well. And so far, they're looking quite good.
It's amazing looking at some of these unemployment numbers, Tom, across America.
Wichita.
2 handles in some places. It's nuts.
2. Columbus, Ohio, 3.4.
Wow.
And like you say, they're places of the 2 handle.
Anna Wonk of Bloomberg Economics. Anna, thank you. The national average, I guess, at the moment, 3.5%. Looking for it to come in at around 3.5% later. But Lisa, to your point, that's been the post-pandemic story, hasn't it? In many places. There was all that criticism. Do you remember the criticism about the White House giving out too much money and people didn't want to come to work? Unemployment was very low. We need to get people back into the working population. And then those conversations died pretty quickly, didn't they?
And a lot of other conversations died with it. Right now, what you're getting is a growing sense of soft data pointing to a very much softening labor market. And I think that you can see that with the quits rate. You pointed to that in the JOLTS data, which I thought was really interesting. The people are quitting less. I also think that the back to work kind of trend, the back to office trend, is very much in direct correlation with the looser job market. If you're more concerned about keeping your job, you probably will be more inclined to go to the office, and your employer probably will feel more inclined to ask you to come back to said office. So I wonder how much we're hearing more about that because
you think the leverage is shifting away from the
without a doubt
employee and back to the employer?
Without a doubt, because you're seeing that right now. I mean, I think that what Meta said that 3 days a week yesterday, they'd like to see people back in the office. Amazon, they were protesting the return to office kinds of policies. And yet, how much protest can they actually do when they're laying off such significant parts of their workforce?
3 days a week's not so bad, is it? Monday, Friday, isn't that, 4-day weekend?
To us, I mean, that's kind of luxurious. But I mean, for different people who have set up their lives over the past few years.
Well, that's the issue, isn't it?
To be working from home, how do you readjust in short order without a pay rise, without some sort of structural changes to your life?
Especially the tech money that wanted to get out of San Francisco and how expensive it was and go somewhere else, Tom. Nice backyard, maybe a swimming pool, cash in that Meta check.
I got a family member that did
Build
this.
a family, not go to the office.
I got a family member that did this, but will they be paid less over the next 2, 3, 5 years? That's the question.
Well, we're on the same page about this. That if you really want to make this happen, have a 2-tier pay system.
I feel like people also are less engaged when they're working from home.
Oh, keep going.
I do. Well, look at that. We're running out of time. But I do think that...
Because we're engaged.
Keep going, Bravo.
Fully engaged.
I'm just about to check the system and see if any managers are at home today. But yeah, carry on.
TV and radio from Tennis Channel, I'm Andrew Guy. A day after her 22nd birthday, world number 1 Iga Swiatek eased into the 3rd round after blasting American Claire Liu off the court. After taking the opener 6-4, the defending champion played an almost perfect set, closing it out 6-love after just an hour and a half on court. The win was Swiatek's 30th of the season. Only Aryna Sabalenka has more victories so far this year on the WTA.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. We started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct to consumer. Like I want to build out a true consumer empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
There's this mountain of cash that consumers had on their balance sheets, and we see that starting to dwindle now.
The U.S. has been more resilient than anticipated.
The bigger shock of the last month is how soft the data outside the U.S. has been.
We look at the leading economic indicators, and they're still all pointing to recession.
I think it's going to be very hard to avoid a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Jobs Day on radio and television. We'll go beneath the headline data here in 29 minutes. Is Krosner in the building?
Randy's here, yeah.
The former Fed governor in the building.
I haven't spotted him yet, but I'm told he's going to be here in 15 minutes.
Yeah, maybe it'll be Goosley with him, and it'll be an interesting conversation. But it's an interesting jobs day coming up, and it's wrapped around a stock market that won't quit going higher, and all of this off of two items of news here, tangential to what we're going to see at 8:30, John, but maybe let's combine them in right now. China, we need stimulus, Bloomberg reports from our team in China. And two, Washington, Anne-Marie Horton says all clear on it.
Well, let's deal with China first.
Yeah.
China basically considering, according to our reporting, a package of measures to support the property market. 1. 2, payrolls later. I think the good thing about today is that the data's good. It's just kind of good news because ultimately there's a belief that it doesn't mean much for the Fed in June. That's the takeaway at the moment.
And the shift that you mentioned from Mr. Jefferson earlier.
Now, that might change at 8:30, granted, but based on what we know so far, that's the interpretation that ultimately you get an inline jobs report, and based on the communication from the Fed Governor Jefferson, who you mentioned, it doesn't look like that's going to change what he thinks they should do this month.
And maybe the theme is data dependency doesn't matter, so what we're all going to do at 8:30 when Mike McKee gives us the data is extend out. Lisa, you mentioned earlier the revisions. I'm going to the 3 months moving average. That's where we end up today.
how much is the risk to a downside surprise that could spur market action more than an upside surprise? If the Fed has basically capped the reaction function to an upside surprise, what happens if you get negativity and this idea that actually job creation is much weaker than people expected and the lag effects are here?
What does Sarah Wolf say of Morgan Stanley? 250 would get it done.
Yeah.
250.
That's a big number.
Without a big revision to the previous month.
Correct.
That's key too.
Correct.
Okay. And then you've got CPI on the 13th. Well, 195. Tom, we've had so many upside surprises over the last year.
It's lifted up.
You can sit here and tell nice stories. I did one about 30 seconds, then they get blown up in 28 minutes' time.
Well, they do, and part of it's going to be wage growth as well. There's a presumption into this report of an ebbing wage growth. Nominal wage growth is maybe coming in a little bit, and of course the disinflation dynamic comes into that as well. So it's not just about non-farm payrolls, but it'll be. I'm fascinated by what we see today because I've been so wrong for 90 days.
You've not just been the only one, Tom. I think everybody has for months and months and months and months. Equity futures, as Tom indicated, positive this morning. Many reasons for it. There's a lift in the equity market on the S&P 500 on the week so far, heading towards a third week of gains. On the Nasdaq 100 is on course for a 6th consecutive week of gains, the longest weekly streak going all the way back to 2021. Yields helping out this week, for once, down about 20 basis points at the front end on a 2-year, off the back of pretty decent data in America, with the exception of the ISM manufacturing read, largely because of the Fed speak so far this week, going into the quiet period, with the bulk of the committee seemingly coalescing around the idea that they can skip June, Tom, and maybe lean into July if they need to.
Oh, they go to July or they go on from there. But again, is it what the lift in rates is a 50 basis point lift.
Busted, absolutely busted.
There it is, great. Right there. Come on, Nadia Level appreciates
this is what,
that.
in fact, I might get in trouble for showing this because we don't have the rights to show it. So he's watching F1. That's what he's doing.
Red Bulls in the
I was
pit.
wondering why you look like you were listening to anything.
Out there.
He's watching,
Come on, this is important stuff.
It's not the. He's watching practice. He's watching practice.
Are you that bored?
It's your fault. I mean,
you're watching practice. You're that into it now.
Daniel Ricciardo told me I have to watch practice to get a better understanding.
I was wondering why you're so distracted. I give up.
I'm not distracted. I'm ready to talk to Nadia Level here and just absolutely dive into the equity outcome of Jobs Day today.
What, whilst you're watching practice?
Thank God the makeup's not showing me blushing. Nadia Level saves us right now. Senior U.S. Equity Strategist at UBS Global. Nadia, it seems like the stock market is going opposite of all the angst in economics. Is that true?
It seems so. You know, it's been a tough market to navigate, you know, as we know that we've seen just wide dispersion in the market, and we have seen one of the narrowest breadth in the market, particularly for a market that's coming off of a bear market localized low. I mean, it's only a third of the S&P constituents that are outperforming the index since the October low. And if you look over the last month, that's even a smaller fraction. So, Tom, I would say this continuous narrowing of market leadership is not a hallmark of a new cycle. And we think that this makes the market a little bit more vulnerable. We know that it's the AI frenzy that's really the powerhouse of late. And we do believe in that trend, but we think that there's just a lot being discounted right now, and we just question the resiliency of this market going forward. It's now trending towards our upside scenario, 4,400 for this year, despite the fact that as you noted, the deteriorating macro backdrop. And so we just don't think that this cocktail is very appetizing at these levels.
Perhaps not on an overarching scale, but I do wonder whether there's opportunity created by just how narrow the breadth has been and the incredible losses in other areas. Bespoke Investment came out with this, that the NASDAQ is outperforming the Dow, or did back in May, by 9.3 percentage points. That is the 9th widest margin of outperformance for the NASDAQ relative to the Dow in history. At what point do you start looking at some of the discarded companies as something of an opportunity?
We have been. I mean, we've sort of been looking at more the defensive areas of the market, like consumer staples as well as utilities, and coupling that with some cyclical exposure on industrials. We are concerned about the economy going forward, and we do think that the economy will slow down. Of course, there's a continuous debate on whether or not we end up in a recession. We think that we're probably going to not see any economic growth by the time we get to the end of the year. So it becomes a coin flip. And so we think from a positioning standpoint, you want to continue to defend, to lead in a bit into the defensive areas of the market and take the opportunities and take some chips off of some of those areas of the market that's really gone up and is feeling a little bit frothy at this point.
I've been hearing so many people say that they're going into defensives. Aren't they overpriced right now based on some of the others? What does it mean to even be defensive at a time when the economy is growing and there's sort of a rolling recession in different sectors?
There is a rolling recession in different sectors, but we haven't seen the full impact of tighter monetary policies. And we know that credit lending standards are tightening. And when you look at the forward indicator, which I think Jonathan has been pointing out for much of the morning, we pay very close attention to the ISM manufacturing index because that tends to have a very good correlation with earnings growth going forward, and that continues to deteriorate. We're even seeing the weakness in the new orders. We're seeing a normalization of that points to additional weaknesses ahead. And we know that credit lending standards have a very good correlation with job growth, particularly for small and mid-sized businesses. And while we're not seeing that deterioration immediately today, it does point to that there will be some ahead. So that's why we continue to believe that a defensive position is the right one in this environment of uncertainty as we get later in the year.
Trade for the brave. Buy the Hang Seng, sell AI. Nadia, are you willing to make it? That's what Michael Harnett brought up this morning over at B of A.
We do have a preference for China. The recovery there has been uneven, but we are seeing some encouraging data, particularly on the service side of the economy as when you look around the Labor Day weekend a few weeks ago. So we would lean in more on those areas, the leisure side of the Chinese economy and not so much the property side.
Nadia, are we modeling in disinflation, which is boosting the PE ratios or the presumed ratio of the market, and particularly the profit-making technology companies? Is this just the stock market getting out 6 months, or dare I say, out a year and expecting a disinflation?
Well, I think when you say about tech, I think people are looking 2-3 years out for AI revenues that might not materialize for everyone. Yes, we do favor the AI, big data, as well as cybersecurity. This is part of our ABC of tech framework that we've been using for the last 2 years. But we do think that you have to become increasingly selective because there's a lot right now discounted, particularly in some of the semi names. So we think that it's less about the disinflation that we're seeing and more about the enthusiasm about the market opportunity for AI.
Nadia, thank you. Nadia Lovell there of UBS going into payrolls about 20 minutes away. The good people of the Delta Sky Club not watching Formula One practice. Coleman writes in, the folks in the Delta Sky Club have good morning show taste, best in business. Thank you, Coleman, appreciate that. You see, even the viewers, Tom, appreciating the programme more than maybe you are. What's the Allen Iverson rant from years and years ago? It's just practice, man. You ever seen that? That's a famous rant, Allen Iverson.
About
just
the
practice
here?
Just practice.
Well, this is an important question because every week they go to a different course and they have simulators, right? And it's serious stuff. They have to memorize the course.
Sure.
I mean, like big time.
And then we get to work out,
like it's like life and death.
What are the best tires to use around this track? How those tires are holding up.
Are they doing that in practice?
That's what they're working out in practice right now. Different fuel loads.
They do 2 practices.
Yeah.
And then they do quality.
You might get free practice 3,
Okay.
Yeah.
And they get a qualifier, which is where you sit in their start.
That's right. That's where that's your position on the grid. Spain this weekend, right? After Monaco last weekend.
This is Barcelona, and it looks like the course is not as tight as Monaco. It's more.
No, it's not a street race in the same way. Yeah. Fernando, can he get it done in his own country? That'd be cool.
33 is his big number. I don't know what that's about. It's like he's looking for his 33rd victory, and it's like.
You know more about this than I do, honestly.
Well, I'm reading Autosport cover to cover every week.
I'm aware.
You
were texting me last night about it. I've got no idea what you were talking about.
The chicane, they took the chicane out. They're making Barcelona like it used to be, unless they're trying to open it up, I think, and make it faster.
Okay. All right. Well, I look forward to your analysis next week after the race.
Yeah. This week, I'm going to do it right after the jobs report because I'm watching practice on Formula One TV.
It's just practice, man.
Yeah.
I can't believe you don't know that rant. Come on. Everyone at home knows that
I
rant.
remember it, John.
Yes, of course you do. Thank you. Former Fed Governor Randy
That's a Greg
Kroesner
sausage.
with us very, very shortly to talk about payrolls. The payrolls report 18 minutes away.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. China's Ambassador Li Hui says it would be difficult for Russia and Ukraine to currently hold meaningful talks to end their conflict as Beijing tries to broker a peace deal. Now, Li has been tasked with promoting Beijing's efforts to negotiate an end to Russia's war in Ukraine, part of a wider blueprint spearheaded by President Xi Jinping, Russia's biggest diplomatic backer. Bloomberg has learned Turkish President Recep Tayyip Erdogan will tap Mehmet Şimşek as his new Treasury and Finance Minister. Şimşek is an advocate of conventional economics. Supporters say his appointment will likely shore up market confidence. Şimşek is set to be in charge of Turkey's economic policies in the new cabinet. Erdogan won re-election on Sunday, extending his more than 2 decades in power. At least 9 people died in clashes between protesters and police after a Senegalese court sentenced the country's main opposition politician to jail, barring him from taking part in next year's presidential election. The government restricted the use of social media platforms, including Facebook, Twitter, and WhatsApp, in an effort to put an end to the unrest. And Novartis AG's Kisqali reduced the risk of tumors recurring by 25%. 9 out of 10 people who received the drug in addition to hormonal therapy after surgery were disease-free after 3 years, compared with 87% of those given just hormonal therapy. That's according to trial results that were presented today at the American Society of Clinical Oncology's annual meeting. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
I do believe that we are close to the point where we can hold rates in place and let monetary policy do its work to bring inflation back to the target in a timely manner. Along this path, I project that we will see modest growth this year, with real GDP coming in a bit below 1%.
Just don't call it a pause, it's a skip. Fed President Patrick Harker doing a decent job of explaining that earlier this week. A decent job of explaining it because this market was pricing in cuts. When it heard pause, it heard cuts. And Lisa, I guess they found an elegant way to tackle that issue this week.
It's working in markets. The market is buying it.
You said that, and that's important.
Right now, you are seeing an increased probability of a July rate hike
even though there is a much greater probability of a pause or a skip or whatever you want to call it at the meeting this month.
TK, data dependent on what data?
They're dependent on today's data, particularly with revisions and 3-month moving average, and then they're going to be dependent on the inflation report coming out, all the depth of that, and frankly, tangential stuff to inflation.
The payroll's 13 minutes away. June 13th, CPI, June 14th, Fed decision. Price action going into it all looks like this morning. Futures up by 0.4% on the S&P 500. Yields just a touch higher by, let's call it a basis point, Tom. Back to about 360 on a 10-year this morning.
If you're across the Hudson River in New Jersey up on the cliffs and you are good at mathematics, you possibly get to go to Brown University and excel, on to Harvard, and then establishing the definitive American financial economics career. Randy Krosner is the former governor of the Fed. He is a professor at the University of Chicago Booth School, and we're thrilled that you could join us on set today. Randy, I'm going to cut to the chase, and this goes back to a paper you wrote with Doug Irwin 1,000,000 years ago on things can change. There can be a theory, there can be a belief, and then things will change. In the time, it was a Republican Party and all that. We've had a pandemic. We've had a series of jobs report. You've given us great perspective. How has the American labor economy changed given this pandemic?
Well, certainly we've talked a lot about the labor force participation rate being a lot lower than it had been before, especially for older workers. So I think that's a long-term change because of these the health issues and health concerns. We've also seen a slower return to work for younger workers. And when they're returning to work, they're not going into the office. And so that's also another long-term change.
One big conversation, Randy, and I'm sure you've been following it. How much of the information we learned today contributes to what we'll see on June 13th in CPI? How important is the contribution from this tight labor market to the price pressure in this economy?
It's certainly a very important piece because labor is such an important piece of the economy. Services is just such an important piece of what happens in the U.S., and that's primarily labor expense. And so if labor prices are going up, that is, wages are going up really rapidly, it's going to be very hard for prices to come down.
I keep asking this. What did we learn over the past 6 months? Because it seems like we're as much in a fog now as we were 6 months ago. So where are we in terms of our readjusted expectations for the labor market, for the stickiness of inflation, for the economic cycle?
Well, I think most people knew that it's easy for the inflation to go up fairly rapidly. It's much harder for it to come down. You know, it came down off its peak, but now it's sort of bouncing around, depending on your favorite measure, 4 or 5%. And I think it's going to be much more difficult for it to come down from there. So I think we kind of knew that beforehand. The challenge is that I think no one expected the labor market to continue to be as strong as it is now. Even the most optimistic people didn't think that. So we're going to have those continuing pressures.
Do you think that that's okay to be able to do that, though? And that's honestly, Tom, what I keep wondering is, do we think that that's actually going to be okay for the Federal Reserve?
Well, that's what the hope is. You know, as I've mentioned on this program before, that's the immaculate disinflation, that somehow we can bring down the inflation rate without bringing the unemployment rate up. We've never done it before. I never say never about anything, but I don't put a high probability on it.
Oh, come on. You picked Goolsbee to be Chicago Fed president. You were out front on that.
All right.
We'll talk about that another time. Jobs Day today is so important. Luigi Zingales, the definitive foreign voice on American capitalism, said the thing that's separate from this country is we clear markets. On a Hayekian basis, we clear markets, we move on. Can we state American exceptionalism right now? That's been a theme around this desk today. Can we state American exceptionalism because we clear markets and a lot of people abroad don't?
Well, I hope we continue to have that because I think that's a very important part. That's a core part of what we are in the U.S. and core part of free markets. I'm actually going to the 300th birthday celebration of Adam Smith's birth just in a week or so with Doug Irwin in Edinburgh. Well, actually, it's going to be in Glasgow.
Okay, that's near Edinburgh.
Are we still clearing markets in America?
Relative is the key word.
That's important.
Relative to other countries.
I'm with you. That's very important. Because certainly it used to be this beacon of capitalism, and we've been taking shots at it a lot over the last couple of decades.
Can you come every day? This is great. You know, let's.
Sure.
You know, we can make
set me up the Bloomberg building here. It'd be great.
Payrolls, Randy. Good news. We're on the same page about Fed comms this week.
Excellent.
I think they've done a decent job.
All right. I thought we were going to have to duke it out.
We don't have to fight. They've come up with an elegant way of really tackling this subject, which was the pause that we were all waiting for them to communicate, and they've come up with this word, skip. What does the word skip mean to you?
I think it means exactly what you guys have been talking about, that it's a temporary pause. So we skip this meeting, but that doesn't mean that you're staying where you are.
And you're not pre-committing to a move after that, whether it's a cut or a hike?
Well, no, I think it's really unlikely that they're going to be cutting anytime soon, as we've talked about before. I think they're going to hang tough. I know that most people in the markets haven't seen them hang tough because it's been 25 years since the Fed has really tried to take the punch bowl away. But I think that's what they're going to do, and they're really committed to that. That's one of the reasons why they keep invoking Volcker. I know most people haven't even heard of Volcker, but Volcker was a very important figure. Really? Who really stood up to inflation, and that's why they keep invoking him, because it was really tough when he was there, and he was hanging really tough. Unfortunately, the unemployment rate went up really high, and they're hoping to avoid that extreme circumstance.
Have we gotten closer to the chance of a painless sort of disinflation that a lot of people talked about, or have we gotten further away?
Well, the labor market still is strong. The challenge is that, if you look at like core personal consumption expenditure index, that ticked up, and that's really much more predictive of where inflation is going than typically the headline numbers. And so the Fed's going to be concerned about that. So that strength in the labor market is going to make it more difficult for inflation to come down.
What do you make of the housing market right now? A lot of people have been looking at it with growing concern, particularly not just in residential, but also in commercial real estate. Is that kind of a tipping point, nonlinear kind of development that could really challenge this notion of a painless disinflation?
So I think you're spot on that. So right now, the residential housing market is okay. There's very little supply coming on out because no one wants to give up their 2% or 3% 30-year mortgage. But if the unemployment rate goes up, then they got to move, or they may not be able to pay that. And suddenly there'll be a lot of supply coming on and pushing prices down. Commercial real estate is in a real difficult position. I mean, people are not going back to the office. Capitalization rates are going to be doubling what they were before, and they don't have 30-year fixed-rate mortgages. They have much shorter horizon mortgages. So we've got $1.5 trillion of commercial real estate that's up for refinancing in the next couple of years.
We all wish we had a 30-year fix with a 2.5% interest rate.
Krosner's got one. Krosner's got one.
We could go back in time and line up outside First Republic. Just give me as much as possible, please.
Don't pay for 10 years.
You know,
Right?
2.5%.
I can see
Just awesome.
John, we could go to the University of Glasgow, the Adam Smith Business School.
That's
with
cool.
Irwin and Krosner. They have the 300-year anniversary. You get a plaid. They have a special Scottish plaid in honor of Adam Smith.
Nice. You wear a kilt to the dinner.
Do you?
Well,
we could wear kilts on the show.
Yes.
Kilts to dinner.
Yeah.
Oh, okay.
But seriously, all the heavyweights are going to be there. We could do the show from there, and
that'd be great.
I wanted to get to Mike McKee for a quick word ahead of
Please.
payrolls, but given the clock and the importance of this conversation, maybe we don't have time. Mike, what are you looking for in about 5 minutes, buddy?
I'm looking for Randy in a kilt. And Tom in a kilt. I think you gotta, if you're leaning any which way, you probably have to lean towards a slightly stronger jobs report, because we've had 13 months in a row where the jobs report has beaten the consensus. On the other hand, April, as you heard earlier from Ms. Wolf, is a month with a seasonal adjustment problem that could bring it down. The whisper number on Wall Street, 225. So seems like most people out there who are watching today, if they're not trying on their kilts, are betting the sort of momentum trade for a 14th month in a row.
Every day I come into work thinking this is a serious program, and I'm constantly reminded.
Whoa.
It's not.
You do? When did you ever come in thinking
Delusional
this is serious?
for the first 5 minutes of my morning. It's going to be a serious day. The payrolls report, 5 minutes away. Equity futures on the S&P, just about positive. Your estimate this morning, 195,000. The print up next.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Let's call it 22 seconds away from the payrolls report in America. The stage set like this going into the print. Equity market futures are positive on the S&P 500 by 0.4%. Yields on a 10-year a little bit higher by a couple of basis points. On a 10-year right now, let's call it 361. On a 2-year higher by 2 basis points, 436. The number we're looking for, 195,000. With the jobs number, let's get to Mike McKee.
Well, good morning, guys. This is one for the Hawks. If you were thinking the Fed might not raise rates, 339,000 jobs created during the month. The prior month was at 253 unrounded. We'll see, or unrevised. We'll see what that looks like in just a moment. The unemployment rate, though, does jump up to 3.7% from 3.4%. So there's a good question for Randy, is which one is the Fed going to look at more closely? Average hourly earnings come in at exactly what was expected, a 0.3 rise. The year over year only goes to 4.3%. That is a tick lower than the Fed had expected and the consensus had expected. Average weekly hours, 34.3. That is down a little bit from the prior month. And the labor force participation rate doesn't change, 62.6. Total revisions a plus 93. I'll get you the breakdown of what months those came from. But again, the big number, 339,000. And if you're the Fed and you're thinking that the labor market is going to slow down, you're going to be disappointed in that number.
Mike McKee, there's something for everyone in this. Let's be clear about that. I'm going to whip through the price action. The initial debate around this table will be 339 screams, let's go again in June and hike once more. The rest of the character of the labor market report this morning, less convincing, and we can talk about that in a second. Let's see if this move sticks at the front end of the yield curve. The 2-year at the moment higher by 8 basis points. The 10-year yield higher by 4 basis points. Clearly, that move in payrolls on the headline number shaping things. That's the early move. I say this almost every single month. Let's see if that move sticks. That's the bond market move. In the equity market, equity futures not really doing much. The S&P 500 positive by, let's call it 0.4% on the S&P. And just to turn to foreign exchange off the back of those high yields, the dollar's showing just a touch of strength. Not much, just a little bit. On the euro against the dollar, 107.54. We're negative there by about 0.1%. Mike, you've had a bit more time to pour through this one. I think a lot of people might have the same question. Well, hang on a minute, Mike. The headline number's massive. What's happening with unemployment? What's happening with wage growth?
Taking a look at the unemployment rate, the number of unemployed rose by 440,000. The number of employed fell by 310,000. And the labor force grew only by 130,000. So this is definitely a story of more people losing jobs than getting jobs, which is kind of a different story from what we had seen in the unemployment rate over the past couple of months. We do have that gigantic job creation number, and a lot of that is, according to the BLS, is in professional and business services, 64,000 jobs. And that was an area that the Fed and others had been looking at, because when you start to see hiring slow down, it's usually in the temporary help services, and those had been slowing down, but now we get a rebound there. Government employment up 56,000 in May, so that was a big contributor. And as usual, healthcare and leisure and hospitality are adding a lot to the level. Construction, interestingly enough, 25,000 jobs, which we had seen in the JOLTS report this week that there were a lot of open jobs in construction, and we're still seeing home builders putting together a lot of work. So it looks at this point, manufacturing, by the way, lost 2,000 jobs, but it looks at this point like still strong job creation, but we're seeing some of the numbers in terms of household tick up.
John, I'm looking at 420,000 plus with a revision, the 3 months moving average, my first math on it. With Dr. Krosner next to me, I really got to be careful here. It's going to be a quality C, 283,000 3 months moving average.
Can someone in the control room get Governor Jefferson on the phone? Can we have a conversation about whether it's still a skip? Ramo, how do you interpret these numbers? 339, big. Then elsewhere, if you took that away and looked at the rest of the report, what would you say June was going to be?
I really can't understand these numbers with a cohesive story, except to say that perhaps the numbers don't tell a cohesive story. What you're seeing right now is greater than expected hiring, and yet a weakness underpinning this that really speaks to the increased layoffs that we see anecdotally. So a real churn that isn't necessarily positive, leaving the unemployment rate at a higher pace. The fact that there is not as great of a wage increase on a year-over-year basis speaks to a lack of momentum there that the Fed's going to lean into, especially with skipping over the past month. I don't understand, though, how we can get these upward revisions, how we can get one blockbuster number after another and then call this a weak economy. It's confusing.
It's kind of the story the last 4 or 5 minutes in the market as well. Leaning into the headline number, big beat, yields up, dollar stronger, equities pull in just a little bit. But as we have more and more of a conversation about the rest of the report, the move at the front end fades. I can tell you with the front end now higher by about 4 basis points. And I know I keep saying this, but bear in mind, it changes so often. You get the initial report, the market reaction, then things fade as the session grows a little bit older. So up at the front end by about 4 basis points. The euro almost unchanged now on the session. Equity markets on the S&P 500 almost at session highs, positive by 0.5. 0.6%. Mike, wonderful to catch up with you. We'll catch up with Mike a little bit later, I'm sure. We'll do that in the next hour as we count you down to the opening bell as well. In the next hour on Bloomberg TV, fantastic lineup to go through these numbers. Mohammed Al-Erin of Queen's College, Cambridge, Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of Peach and Fixed Income. TK, just to break down what we've heard in the last 5 minutes or so, push it through this market and talk about CPI on the 13th, the Fed on the 14th.
To me, it's a terrific, terrific jobs report. It'll be interesting to see what your team says at 9 o'clock as well. With us again with Michael McKee is Randall Krosner, professor at the University of Chicago Booth School and, of course, a former Fed governor. At least I thought captured it beautifully, Professor Krosner, the confusion we have, the movable parts of labor that is in any labor economics textbook. Which movable part of the American labor economy matters to you right now?
Well, probably the piece that matters most is what's happening to wages, and so that the Fed can take a little bit of comfort in that despite the very strong numbers the headline numbers that we saw in the upward revisions, we're not seeing an intensifying wage pressure. But that's going to be really the key that the Fed will be looking at, because that's what feeds through to costs of services and then CPI, PCE, all of the implications for where inflation's going and cost of living.
This is messy data. This is really messy data right now, because it's not just with respect to headline numbers. It's also the compositional story here. Which jobs are being added? Are they lower income jobs? Is that what we're looking at? And then what does that say about wage gains? Does that really give you an apples to apples comparison? Is part of the reason why data dependency is taking on less importance simply because the data is too messy to really read in any kind of clean manner?
Yeah, you bring up a very important point, because it's really important to unpack those numbers and look at the composition. Is it that, where are the layoffs happening? Are they happening at the lower end of the income spectrum? Or are they happening at the higher end of the income spectrum? Because that makes a very big difference for what average wage growth is going to be. So important to unpack that. Undoubtedly, that's what the people at the Fed will be doing. But we'll see. I think my guess is this will be consistent with a skip. But one never knows.
We're going to have with us Randy Krosner. We're going to continue with Professor Krosner here in a moment. Again, a lift to the equity markets off of where we were before the report. The VIX is stunning, 15.32. To imagine a 14 VIX will be extraordinary. 2-year yield out 5 basis points as well. Oil with a bit of a rally, off, I should say, from the jobs report. Dollar weakness this morning. Professor Krosner, I want to go narrow on you now. I can do this because you're so damn good at this. But the answer is, there's been angst over the last 10 days about the revisions that Mike McKee talks about. Nobody trusts him. Jack Welch, the late, great Jack Welch of GE, didn't trust Bureau of Labor Statistics and all that. There's a thing, the birth-death adjustment to all of this statistics. Explain how experts like you are not worried or don't have the angst that we have in the birth-death study.
So I think just stepping back, bigger picture, I don't think these numbers are politicized. I do think they try to do the best job possible. But it ain't easy every month trying to come up with the total number of workers in the economy coming in, coming out. And so you have these challenges of seeing, well, what are new firms coming in? What are firms that are exiting? How well do you cover those? And that's one of the issues that comes up. So when there's a lot of churn in that part of the market, which there is right now, you can get some of this volatility.
As you take a step back, especially with the upward revisions, can we make some assumption that perhaps there should be an increased pricing of further rate hikes down the line, that perhaps Citigroup's Andrew Hollenhorst is more right than some of the people who are saying that there are going to be rate cuts starting in September?
Yeah, I don't see any evidence for rate cuts coming anytime soon. Now, there could be some sort of geopolitical event or something extreme like that happens. But for that, the Fed is going to hang tough. They remember what happened to the Fed in the late 1970s, early 80s, when the Fed pulled back too quickly, when they thought, we've vanquished inflation. They didn't. Inflation went back up, and then they had to raise rates to double-digit levels. They don't want to do that. They'd much rather move things up to the upper 5s rather than take a long pause and then have to go to 8 or 10.
How high is the threshold right now to cut?
Oh, I think it'd be very, very high. Unless there's some sort of miracle where we get this immaculate disinflation and inflation just falls like a stone, which I have seen no evidence for, they ain't going to be cutting anytime soon.
It's a beautiful chart. We're not going to show it today with all the moving parts here. But if you look at the standard deviation of American unemployment, 3.7% is still an act of God. Michael McKee has parsed through all the data. 3.70%, Mike, we're well within the center tendency of the post-pandemic trend. In your mind, what's the level of unemployment where we begin to change this dialogue?
Well, I think most people at the Fed have said you got to get at least over 4.
Four
has been what they considered sort of the neutral rate for a long time, and we've obviously been below that. But even at 4%, that's lower than it was a couple of years ago in terms of what a neutral rate would be. So I think there's certainly scope for them to fall more. Now, interesting decomposition of the unemployment rate. We had seen a lot made of the fact that black unemployment had fallen to the lowest ever. It has jumped up significantly, almost a full percentage point, 0.9% higher than it was in the last report. So at this point, we're looking at 5.6%. So a big increase in black and African American unemployment, which is not necessarily a good thing.
Just joining us, Markets on the Move. Lisa Bramwitz, Tom King, John getting ready for the next hour. Randall Krosner with us from the Booth School, Chicago. Michael McKee with all of his abilities as well. Coming up, Ira Jersey will join us in the bond market. Gina Martin Adams on lifting equities to the moon. She has said participate in stocks. And Jeff Rosenberg has summed all this together at BlackRock and joins us right now. Jeff, I'm going to ask you a Krosner-like question, which I'm sure Carnegie Mellon, you know Carnegie Mellon economics, right?
Yeah.
You know, it's like first-rate stuff. Jeff, I'm going to ask you here about the bombshell from John Williams a couple days ago, which is R-star stays lower, which I believe signals a shift lower in interest rates. Are you investing at BlackRock presuming lower yield, higher fixed income price?
Well, it's really been a story of quite the opposite, Tom, right? It's about...
I think we have a frozen Jeff Rosenberg. I think we
Sorry, no. I'm still here. The producer was just in my ear there for a second. it's been going in the opposite direction. Obviously, it's about higher interest rates, and we've been investing along that way, as he talked about in terms of the curve. We're facing an inverted yield curve, and so the highest interest rates are in the front end. The long-term R-star story is really about whether or not policy is tight right now. And if R-star is as Williams laid out, then policy is tight, and that's what the Fed believes, and that's why they're taking a pause. What today's labor market report sort of says is, where's the tightness? You've raised interest rates 500 basis points. We're still delivering over 300,000 jobs. So the disconnect here is that you're not really seeing the slowing in the labor market. Where you're seeing the slowing is in the goods producing part of the economy. And the split in the outlook is goods and survey-based data on goods is at recession-type level, but services are holding in just fine. So Randy said earlier, you got to look at the details. One of the details that sort of sticks out here is a turnaround in the goods producing areas of the economy in terms of hiring. That's a little bit worrisome for the Fed and the inflation, because all the disinflation is coming from the goods. And so if goods prices are stabilizing and goods hiring is increasing, which is what we see in this report, then you may have the consensus outlook here, which is focused on these NAPM surveys, the PMIs, we got it earlier, the ISMs, collapsing into recession levels. That may just be a nominal effect, and is really not telling you the story. And for the Fed, yeah, it's a pause. Or a skip. Sorry, it's a skip, and then a couple of more strong reports, and it may not be that the rates and the real rate is as low as Williams thinks it is, because you're not getting the effective tightening.
Jeff, I keep wondering whether people have gotten too sanguine on the idea of inflation coming back to that 2% level of the Federal Reserve. And I'm looking right now at break-even rates, 2.2% over the next 5 to 10 years. Do you think that the suggestion here, with a skip by the Fed and a hot labor market report, suggests a stickiness and a resilience that is not priced into this market?
Well, it's certainly not priced into the break-evens. They are reflecting the immaculate disinflation. And, the evidence hasn't really shown anything to support the immaculate disinflation. So there's very much a hope trade going on here in the fixed income market in two factors: the hope that inflation immaculately falls, and then the second implication of that is the Fed's going to be able to go back to its old playbook and ride to the rescue of asset prices and asset inflation, and cut interest rates by the end of this year, which is, again, you just don't see anything in the data that supports that. So I think this report is a little bit challenging. Yeah, the unemployment rate helps a bit, but it's a very noisy data series, and so we'll have to see there.
Miranda Crossan with us, as well as Jeff Rosenberg, and again, we'll get to Ira Jersey. And Gina Martin Adams on this stock market that won't quit. She's been very good about that. Professor Crosner, I want to go back to Frank Knight, the advent of the Chicago school, and it came out of something I got totally wrong, which was my grandmother talking about the pandemic of 1918. We used to laugh at Grandma. We laughed at Frank Knight and everybody else who had to live that pandemic. We're coming out of our own pandemic now. Can you practice the evil trade of labor economics now, or is there just too much uncertainty to know what's going to happen forward? Surprise after surprise after surprise. Do we really know what we're doing?
Well, I mean, obviously, we don't have pandemics all that often, and so so you've got two main data points: the recent one and one from a century ago. So it's hard to make sure that you've got your models really well calibrated. But that said, I think we see some general characteristics that make sense. As we were talking about before, you're going to see lower labor force participation by older workers. You're going to see a reluctance of people going back to the office. So I think those things are sort of broadly predictable. But the strength that we're continuing strength in the labor market, but for 500 basis point increase by the Fed, that is pretty surprising.
I mean, you take the Jeff Rosenberg across the century here from pandemic 1 to pandemic 2. Frame with your fixed income view, Jeff Rosenberg, the distance from Goolsbee to Bullard. Right now, it seems extraordinary.
Yeah, there's a long way to go here, and as Randy just echoed, 500 basis points is a big increase, but there is the other school of thought on this real interest rate that the pandemic ushered in, some significant structural changes that effectively raises the real interest rate. And if the real interest rate is actually higher, then the Fed nominal interest rate has to be higher in order to get tightening in. Now, we just have to be in this period of uncertainty, and it may be long and variable lags, and it's just around the corner, and labor markets can change very quickly, and we can, get into negative numbers on the headline payrolls, and then the Fed will be justified in the skip. But the lack of momentum, the lack of evidence on making any of that progress, and the longer that proceeds, sort of starts to push on the other argument that you really have had a structural change here. You need a much higher interest rate. There's less interest rate sensitivity. And the other big thing here is the balance sheet and liquidity. And perhaps we'll look back on this period and recognize that, it wasn't about the interest rate. It was just that you had this legacy of excess liquidity that you had to wait to get that liquidity out before those interest rates started to really bite. And if you waited too long, perhaps that allowed inflation and inflation psychology to take hold. And that would be, where we go. But, that's one potential path.
Just real quickly here, Jeff, given the uncertainty and given the inability to really get an edge on data that's moving quickly and that really has defied a lot of expectations, what are you pushing back against? Where do you get conviction in terms of market positioning, given that there are so many question marks around some of these big parameters?
It's really hard. There's very little conviction. If you take this consensus view, 65%, 70% probability of recession in the next 12 months, it's recession is the consensus. And, you look at a report like today, you look at how well financial markets are holding up in terms of beta and returns. Yes, there's a big AI and tech, and we're back into tech dominating, 7 stocks that make it. But, there's not a lot of recession risk priced into the financial markets. Look at credit markets and credit spreads. They're at mid-expansion levels. So if you're going to push back anywhere, I think the pushback is this kind of 70% consensus probability of recession right around the corner. And that's the issue, is it's just not right around the corner. That's what this report tells you. It's pushed out further and further. It's the long and variable lags. So that time dimension is, I think, the thing you push against.
Rosenberg and Krosner pushing up the 2-year yield 10 basis points, 4.44%. Krosner never did that when he was at the Fed. Professor Krosner's with us. Jeff Rosenberg, thank you so much with BlackRock today. Really look forward to hearing from you through the month of June. Just because of time here, folks, Ira Jersey is going to go back with Bloomberg Intelligence and write up this important note for terminal users worldwide. We're going to jump to the equity markets right now. Gina Martin Adams joining us here. Gina, I sort of said this on air, but I said it much more off air today. Are we on the precursor of a melt-up, which is basically due to obvious short covering and far more just a general caution out there I hear in every conversation on the stock market?
I think you've hit the nail on the head, Tom. What's happening in the equity market is that everyone was expecting a recession. As of late last year, we were pricing a material recession emerging in both the economy and earnings stream. And all of the data so far that we've had this year has only surprised us to the upside, including within the S&P 500 earnings results of the first quarter. Analysts were expecting a greater than 8% decline in earnings year over year in the first quarter. They got a 3% drop. Many companies actually started beating expectations. What I think we're seeing right now is the effect of slower inflation now starting to prove out as margin stability in the S&P 500. And that's actually brightening the outlook for earnings, even while most of the narrative is still surrounding this economic recession that we've all been waiting for. The earnings stream is showing that the S&P 500 is about to go through some form of a healing process. So that creates a lot of moving parts in the index. You see some stocks certainly celebrating the better news out of the earnings stream, as well as hopes for better earnings going forward. Other stocks still struggling with the economic weaknesses evident in the goods industries. But it is a lot of moving parts. Net net, I think the result is we were expecting a very big drawdown. We're not getting it.
Gina, those better seeing that accompanied with more job cuts, with more general cost savings, or is this actually encouraging more hiring that flies in the face of an unemployment rate going up materially?
Oh, I think that's an excellent question, because what we detected actually is the peak job cuts occurred in the fourth quarter of 2022. And even when we look at sentiment towards labor imbalances within the S&P 500 transcripts, we actually see S&P 500 companies talking about labor imbalances now not as much of an impediment to growth going forward. If you look at actual job cuts and announcements, if you look at initial claims that resulted from those job cut announcements, we saw job cut announcements peak in the fourth quarter and early first quarter. They've actually started to trend down slightly. We saw initial claims then lag that peak with a peak over the March-April period, and initial claims have even started to downtrend a little bit. So what we could be experiencing is this very lumpy experience in the S&P, really focused on the tech sector layoffs, the communication sector layoffs, some additional financial sector layoffs. The groups that were excessively employed as a result of pandemic conditions have now laid off workers, and they're telling us that their conditions are improving going forward. They now feel like they've generally right-sized their labor force, in particular in tech and communications, which really led us into this week period.
Yeah.
Those groups are telling us that they've right-sized their labor force. They're feeling a little bit better about their sort of demand versus supply dynamics, and we've got a more stable environment for 2023 relative to 2022.
Randy, this doesn't sound like immaculate disinflation. This doesn't sound like what the Fed wants to see, even if they do skip the next meeting, although people are kind of questioning that a little bit more after getting some of these numbers. Do you think that people have written off this idea of inflation being stickier and frankly had too much confidence in the Fed's conviction? I know you're saying that they're going to hold rates higher, but we haven't seen the pain, and they're already talking about the balance of risks to the downside, and you're not seeing it in the economic data. Are you concerned that this Fed is not taking the longer-term risk of inflation seriously enough?
No, I think they are. I think that's why they raise rates so rapidly, and it's such with such big steps. Now, I think taking some time to assess, given the long and variable lags, that seems perfectly reasonable. But they made it really clear that just by skipping or taking a short break doesn't mean that they're going to be cutting.
So do you think that they could get to 6%?
For sure. If inflation continues to be persistent as it is, I mean, we saw both the core and headline personal consumption expenditure index, the PCE, which is what the Fed focuses on, that ticked up. That didn't tick down. And so it certainly came a lot down from its peaks, but that's what the Fed's going to be looking at. And if we're not making progress there, the Fed's going to have to keep at it.
We're going to spend the rest of the time with you. Gene, I got one question here. When does tech break? Can you give it to me within a day or week here? When does tech finally break at Bloomberg Intelligence?
You know, I think honestly, Tom, when you look at the sequence of what's happened so far this year, it's not just about tech. I understand that we were really focused on the biggest 5 stocks in the index, but it really is an accumulation of growth stocks recovering after last year's weakness. So it's tech, it's communication services, consumer discretionary. All 3 of those sectors have led the charge so far this year. Yes, there is a heavy, higher market cap concentration tilt to that, but the sort of reality of what's going on in the S&P 500 is the losers of 2022 have become winners in 2023. The winners of 2022 have become losers in 2023. And it's very consistent with what we're seeing in the earnings trends.
Gina Martin Adams, Ira Jersey, thank you so much. Ira, so sorry we couldn't get to you today. We've got Krosner on set, so we're going with that. I want to get one in here, and Lisa, I know, wants to jump in as well. There are people that say this chairman has failed and he should go. Defend Jerome Powell.
So I think all central banks around the world were too slow to pick up on the persistence of inflation. Fed was talking about it as transitory. Other central banks were talking about it as transitory. They shouldn't have been doing that for as long as they did. I could understand for the first few months, but by the fall of 21, they should have kind of figured that out. So I think that's an issue. However, I think the Fed has done a good job of pivoting and saying, okay, inflation is our main priority. We've got to move rates up. They've moved rates up very significantly. I think a success is that inflation expectations have not become unanchored. That was the main concern, because this is what happened in the late 70s, early 80s, when the Fed lost credibility, and that's why they had to raise rates to double-digit levels to bring inflation down. So far, the inflation rate has come down without the Fed having to grow too far, but we'll see. I mean, you know, you often ask me to give people grades. Obviously, this has to be an incomplete.
I love the D you gave me. Lisa,
never give you a
Lisa from the University of Chicago, jump in here with a professor with a final question.
Well, you were talking about the potential to raise more, and I think perhaps there's another question. Are people underestimating the duration of the Fed holding rates where they are? And will that potentially be something that's more dramatic than even raising rates further, which could accelerate a break and then some sort of retracement? The sort of drip, drip, drip of deposits out of banks. Have we seen the full effect of that on lending?
So I think for sure I think that's one of the reasons why the Fed wants to take a little bit of a skip right now, because I think they want to step back and assess what's really going on with the banking system and with credit flows. We've seen more and more reports that small and medium-sized banks are not are pulling back, and that small and medium-sized business are finding it more difficult to get credit, because you have the combination of the higher rates and then pull back in credit. That's going to make it much more difficult for these jobs to continue to be created. And so I think that's why they want to skip now.
Doesn't it just, you begin to tear up when the Chicago law student nails the x-axis analysis versus the y-axis? I mean, it's like, it's in the ether at Chicago, isn't it?
For sure.
She crushed it with that question. No question about it. Randall Krausner in studio. We're going to make this a monthly thing to have Professor Krausner with us. Truly wonderful former Fed governor, of course, with the Booth School of Chicago. I don't know what to say after month after month after month. You never know what to expect with a jobs report. I expect the VIX 15.30, a 14 VIX. This is Bloomberg. Good morning.
And we get another one, another big payrolls beat, a complex report that we need to figure out through the next 60 minutes or so. Equity futures positive on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York coming up. Jobs growth in America defying the gloom as the Fed gets one more last word before going quiet. The debt limit deal heads to the president's desk. We begin with the big issue, a week of contradictions. A big increase in job vacancies, jobless claims still ridiculously low, all backed up by strong payrolls growth, contradicted by numbers elsewhere in the jobs report, another weak read on U.S. manufacturing, and a long list of retailers warning about a struggling U.S. consumer. The Dollar General CEO saying their customers are relying more on food banks, savings, credit cards, and then Macy's boss indicating they planned the year assuming that the economic health of the consumer would be challenged, but starting in late March, demand trends weakened even further. All of this leaving the U.S. Central Bank dazed and somewhat confused ahead of its next policy meeting. Joining us now to discuss is Mohamed Al-Erin of Queen's College, Cambridge, and BlackRock's Rick Reeder. Mohamed, first to you. We've got to figure out what on earth is this payrolls report this morning?
So the 14th straight upside surprise. Now there's 20 out of 21 upside surprises. Look, the U.S. economy remains a major engine of job creation, and that is good news. We also know that the U.S. economy is increasingly dualistic between what's happening in manufacturing in general and what's happening in services. And all this, including today's job reports, complicates the Fed's policy challenge. Whether you call it a skip, a pause, or hike, it certainly complicates it. And I must tell you, it's going to amplify already the high criticism about communication. People are now going to be scratching their head. Why did they guide the market so strongly towards a skip ahead of this report and ahead of the next CPI?
Rick Reeder, your first take, please.
So, I mean, listen, 339,000 jobs, a lot of jobs. I continue to say, if you go to these component parts, and we talk about this every month, leisure and hospitality, education and healthcare, you're seeing, I mean, they're still not there yet in terms of there's still a tremendous number of workers that have to be higher in those spaces. They're still below the trend line post-COVID. And so that, I think that is persistent. I still think you'll see more of those jobs come in. There's a very interesting nuance to this. You're getting functionally all the job growth you're getting, or the supply of the labor is coming from international, from immigration. And that's part of, you're seeing wages that are coming down a little bit. We're expanding that labor supply. I mean, it's something
that you think about what has to happen in UK and Germany, et cetera. But that's a big deal. We're hiring a lot of people, and it's coming from international because you've seen a lot of people leave the labor force that have retired. So that is encouraging. But listen, I think, I still think we're going to be in this. I think the Fed getting to the 4.5 unemployment target or what they've projected is hard.
Mohammed, you mentioned some of the contradictions. I talked about them as well. Let's just dig further into this labour market report as well. The headline number on payrolls, Mohammed, is screaming go again, hike once more in a couple of weeks' time. The rest of the report, Mohammed, does it contradict that to some extent? We get two surveys here, establishment, household. Are they telling you two different things?
Oh, they are. But if you look over time, if you were to take the whole series, then they're telling you a pretty consistent story. And they are telling you, as Rick rightly said, that you have a dualistic economy, that we continue to be strong in terms of labor demand, and we continue to create jobs. Fortunately, the supply side is responding, as Rick said. But the Fed is going to have to make a really difficult judgment. Does it expect the supply side of the labor market to continue to allow wage growth to remain very muted, or will it worry about what the JOLTS data told us? So this is tough. This is getting really tough.
Yields up at the front end by 7 basis points, 441, slightly pricing back in a prospect, the risk, the potential, probability that maybe we do get a hike a little bit later this month. Mike McKee dropping by the studio, guys, to catch up with us too. Mike McKee, you've had about 34 minutes to explain this one. What is the explanation?
It's not a particularly good explanation. It is quite a divide between the household and the establishment survey. The establishment survey, as you have been talking about, comes in at 339,000, and April was revised up significantly to 294,000. So still very strong hiring, at least from the company's point of view. And then you have that establishment survey that shows a big drop in the number of people who had jobs, and the unemployment rate goes up to 3.7%. How do you square those two? The average hourly earnings comes in pretty much bang on estimates, although on a year-over-year basis, down a tick to 4.3%. But it still suggests, as you did, John, that it's a bifurcated jobs market. We're seeing strong hiring, but the other categories could give an opportunity to the Fed if they want to hold or skip this month. Interesting, in construction, we saw a big gain, 25,000 jobs, and a lot of that is civil construction. In other words, is the Biden IRA plan actually starting to contribute to growth now? Is construction turning around, not just residential, but for the big infrastructure projects? Government, 56,000, you wonder if that's a seasonal thing, because a lot of hiring for schools reported, but schools are getting out in the month of May. Professional services, interesting, because usually that goes down when you're going to see the economy slow. And leisure and hospitality, our favorite category, as Rick was saying, still adding. So where does it leave the Fed? Interestingly enough, the WIRP function on the Bloomberg now shows a 40% chance of a Fed move. Yesterday, it was 23% in June. And here's the lineup. Now, I put that new title on there because really we saw Phillips and we saw Harker say this twice, but it only got Wall Street's attention the last time they did. They haven't really changed their views. And here's kind of the lineup, and the ones who are bolded there are the ones who are voters. So it's about even at this point. Be interesting to see how, if at all, this report affects their views.
Mike McKee, thank you. President Harker, we should skip this meeting. Governor Jefferson early this week, skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. Mohammed, if we got Governor Jefferson back on the phone, do you think the message would change?
I don't know. I mean, I smile a little bit because thinking that 1 month of data is going to make a huge difference is, I think, fooling yourself. But they have framed it that way. And it's a shame because I think it's such a narrow framing, John. We're all now discussing, is it a skip, is it a pause, when there's such bigger issues involved. And that's the risk of being excessively data dependent, is that you get stuck in a sort of small and smaller corner, and the data will pin you there. And as the data becomes fluid, it pins you there even more. You've heard me say over and over again, we need a strategic view of this economy from the Fed, and they need to know where they want to end up, because right now they're excessively data dependent.
Going into the June meeting, Rick, going into this morning even, there was a feeling that we had de-emphasized incoming information going into June because they started to coalesce around the view that they could skip this meeting. I don't think this morning I know what to do with this data when I push it through the bond market, Rick. The market initially sending yields higher by 6 basis points on a 2-year to 440. Others might be looking to fade that. Rick, how are you thinking about that? Have we reintroduced a higher risk now that they do go this month?
Yeah, I mean, I still think I think they're going to pause. If you gave me, but it's not that clear, and we've got CPI report to see. So, and which, by the way, we think is going to be a firm number. So, listen, I think you can pause. I mean, you move rates 500 basis points, you will start seeing credit contraction. And people say when you look into the numbers, I mean, we see it through our platform. All of a sudden, the financing dynamics around where the banks used to lend, we're now being asked in a bunch of different places. You're going to see credit contraction. And the thing I throw out there. We talk about the components of this job report. You lift interest rates, and it hits the cyclical parts. What's clearly slowed is the cyclical parts of the economy. But Mike McKee said construction is different because of the infrastructure build that's going on. But gosh, are you going to really impact healthcare and education hires? Not really. And the question is, can you pause? Can you watch some of this data play out? The data is, the economy is normalizing, and you see it. Is it slower? In inflation terms, it is. But boy, we're going to get more data, and I think it's going to tell you economy's normalizing to a more moderate pace, and you can take some time with that.
And in the meantime, by the NASDAQ, Rick, this rip-roaring rally we've seen in the NASDAQ 100, I think this is week 6 consecutive weeks of gains, and this morning, NASDAQ futures up again, big time and doing nicely going into the opening bell. Rick, at the start of the year, it was all about there is an alternative. There is an alternative. You can go to T-bills, money market funds, pick up 4-5%, do what you will. And now it just feels like the fear of missing out is kicking back in, Rick, into the equity market. Do you feel some of that?
100%. I mean, we've led, I'll tell you a couple of things that are interesting around the equity market. The volatility, you look at the VIX index, I think on the prior show we were talking about it. People are not long. It's the reason why volatility is priced so cheaply. People don't need to buy insurance because they're generally not long. You see that in high frequency data. And so, by the way, it's been you can build a portfolio to carry a lot of income and then buy upside convexity in the equity market and can ride some of this move. I think the technicals in the equity market are really good. By the way, you're not getting a lot of issuance. Companies are buying back their stock, and people aren't long. You've got this incredible technical, and there's an interesting flight to quality trade going on here. You look at the big tech companies. We've been able to talk a lot about AI, which is true and sincere. But there's also, you look at the cash flow generation. You look at, it's a bit of a flight to quality trade in a lot of these companies is going on. That's not terribly different than keeping some income in the fixed income market in the short end of the yield curve.
One man's bull market, another man's bubble, Mohammed. I'm trying to work out which one it is. I guess it depends whether you're in it or outside of it on the fringes watching it.
So I'm with Rick. Look, the equity market benefits from what I call the notion of all-weather stocks. Stocks that are viewed as either riding a huge secular wave, or alternatively, stocks that are viewed to be insensitive to economic and financial fluctuations. And they have led the rally. In a way, I think equity market participants are very lucky. I feel sorry for the fixed income participants. Imagine we have a Fed policy meeting in less than 2 weeks, and in the last 3 days, the probability of what will happen at that meeting was, as you heard Mike correctly say, 60% hike, down to 20% hike, back up to 40% hike. That is the world that the fixed income people are having to navigate. So relative to them, the equity market looks really very steady and sort of easy to navigate.
Mohammed, if only things were that easy. You've complained about the Fed not taking a strategic view. As a market participant, can you take a strategic view on the direction of things?
So I worry, John, that this Fed will end up pushing the economy into recession. I worry that this will happen for the 3 reasons you know. One is the lack, not just of a strategic view, but of a valid monetary framework. 2 is I think they have the wrong inflation target. And 3, they're trying to restore their credibility. So that's the concern. Otherwise, I think it will be easier to navigate, but the risk of yet another policy error, I fear, is quite high.
Rick said pause in June. That's his expectation, not his recommendation. Mohammed, when we spoke last week, before we had this data, your expectation was rate hike in June. What is it now?
So if they are serious about that 2% target, given the data, they should hike. Okay, if they are true to their word, they should hike because they are data dependent and the data has been hotter than expected. The surprise index, John, is at levels we haven't seen for a very long time, pointing consistently to stronger than expected data. So if they are true to their word and true to their target, they should hike. I would not hike, but then I have sort of broader issues, as you know, in terms of how I would be thinking of monetary policy here.
Mohammed, Rick, you're going to stick with us, I'm pleased to say. The equity market right now going into the opening bell, equity futures just about positive on the S&P 500. Let's get you those movers. We can get to Abby. Hey, Abby.
Hey, John. Well, we're looking at the best day in at least 3 years, I believe, for Lululemon after they put up a big beat and raised quarter. Their adjusted earnings were 16% better than estimates, sales 4% higher. The full year outlook was raised. China is strong and high-end demand staying in place. So the conundrum of different levels of retail continues. MongoDB, the database company indirectly related to AI, they put up adjusted earnings of 56 cents, 200% better than expected. Sales beat, they boosted the outlook, huge upside ahead according to some analysts. Those shares are soaring. And then finally, rounding it out, Cliffs Natural Resources, or Cleveland Cliffs, up 5.3%, the best day since early January. Iron ore is up 2.6%. Steel rebar is up more than 1%. That stock is rallying.
Abby, thank you. China, a massive part of this conversation we'll get to in just a moment. Coming up, the debt limit deal clearing the Senate.
This demanded a bipartisan solution. We knew we'd need to come together for a solution.
The deal the House passed last night is a promising step toward fiscal sanity.
More on that and another big payrolls report with Mohammed Al-Arian and BlackRock's Rick Reeder.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
On this vote, the yeas are 63, the nays are 36. The 60-vote threshold having been achieved, the bill is passed.
63 to 36, the Senate passing the debt limit deal with ease.
This demanded a bipartisan solution. We knew we'd need to come together for a solution like the one that passed tonight. And so I'm happy to stand here passing this critical legislation to support our families, preserve vital programs, and most importantly, avoid catastrophic default.
The deal the House passed last night is a promising step toward fiscal sanity. But make no mistake, there's much more work to be done. The fight to reel in wasteful spending is far from over.
The president thanking Schumer and McConnell, calling the agreement a reminder of what's possible when we act in the best interest of our country. I look forward to signing this bill into law as soon as possible. The president set to address the nation this evening from the Oval Office. Joining us now, Bloomberg's Anne-Marie. Morning, Anne-Marie.
Good morning, John. That's right. The president will address the nation this evening, talking about the debt ceiling deal that he got through Congress through a bipartisan fashion. Late last night, it was finished in the Senate, really through the moderates of both parties. One way that Senator Schumer and Senator McConnell were able to assuage some senators' concerns, especially on the GOP side when it comes to these defense hawks, is that they said that this bill does nothing to limit what they can appropriate in emergency spending fashion. So potentially, Jonathan, not quite the exact spending fiscal restrictions we will see if you start appropriating more funds through supplemental means. But this would be a win for the president. I imagine this evening he will also address what we saw this morning when it comes to those non-farm payroll.
A win for Speaker McCarthy as well. Big win for the president if he wants to talk about the headline number, but elsewhere, slightly confusing. AMH, thank you. Down in Washington, D.C. Rick, onwards, we move on. Hundreds of billions of dollars of T-bill issuance just around the corner. Do you see that being a problem?
There's no doubt. It's funny. I always think, we've all been talking about this debt ceiling. Markets can only do one thing at a time. They can only focus on one thing. Now you just hit on the thing that I think is significant. We're gonna drain $1 trillion of liquidity from the system in terms of bill issuance, $500 billion to replace to replenish the TGA. It's a big deal. I mean, that coupled with the Fed, that is significant. When you drain that much liquidity, it's symmetric to QE. You watch how markets move relative to that. The one thing that I think is different than that draining of liquidity, people have been sitting on their hands for a long time because of all the risk, debt ceiling being a big part of it. There's a lot of money in this system that I think will be able to absorb this, but it's going to be a big focus for the next couple of 3 months.
Mohammed, what does that T-bill issuance compete with directly?
So it competes with what depositors in banks will do otherwise. I mean, what will tend to happen is attract more money out of banks into money market funds. Look, John, there's two things to watch. One is how they are absorbed, and two is market functioning. I'm pretty actually optimistic on both sides that it will be able to be absorbed and the market will function well, but keep an eye on that. More generally, John, and we've taken now two headwinds out of the way. People tend to use the word crisis inadvisably. So people talked about a debt ceiling crisis and a banking crisis.
Yeah.
Well, both crises, which never were crises, as you know, but both of them have been taken out of the way. They're no longer headwinds to the economy.
You
or to the
sound
market.
almost constructive, Mohammed, on equity markets in a way that I haven't heard you sound like this for a while.
Oh, no, for weeks now I've been saying these are fairly priced for what we don't know. Okay, I've always felt that we would resolve the debt ceiling issue. That was the working assumption for most people. They will get resolved, and it has gotten resolved. It's not going to materially change the economic outlook, but there's lots of issues that we don't know, including what we talked about earlier.
A lot of people are in cash, Rick. You were in cash. You've slightly chipped away at that. I think we've been tracking your cash pile over the last several months. Where is that cash pile now, and Rick? And I think we need to talk about that moment for a lot of people who went to cash 4-5%. The decision to go to cash is the first call. The second call is to get back out of it. And I think we often say the second call is the harder decision to make, Rick. What's your advice to those people sat in T-bills right now, sat in cash?
I'll tell you, I would still own a bunch of them. I mean, at the end of the day, I mean, this is a pretty, you made the point about, for fixed income, it's a tricky period. It is a tricky period, but there are a couple of things that I think are really powerful. One is you can carry really high. You talk about this bill issuance, you're talking about buying, you can buy 1 to 3 year maturity investment grade credit. And by the way, in Europe, swap it back to dollars, get over 6%. That's pretty good. I mean, you're not taking credit risk. You're not taking really any significant interest rate risk. So you can so there's that to do in the markets. And I think people, will continue to put money into these, to what are some pretty significant yields that you haven't seen in the past in quality assets. And then the second thing, Jonathan, that I think is critical, we lived for 10 years in zero rate environment or low rate environment. and assets, financial assets became potatoes. It didn't really, they were, all the same, they all went up or they all went down because you had massive monetary policy. Now you're getting massive dispersion. And one of the things that's interesting in fixed income now, emerging markets are interesting relative to some of the credit markets because of different inflationary dynamics. You're seeing real defaults in places like commercial real estate, parts of the lev loan market. So there's things to do in fixed income today that I think, particularly if you can actively manage it in today's environment, it's really interesting. I would argue there's not a big fat pitch for, is there a big rate trade? But I think there's a lot of things to do now, given we're going to see more volatility, more dispersion intra a lot of these markets.
One thing we can agree on, this market ain't boring right now. Rick Reeder, Mohammed Al-Erin, to the two of you. Wonderful. What a privilege, a pleasure to do this with you guys every first Friday of the month post payrolls. Big report from the payrolls report. Coming up, the morning calls and later, US jobs growth defying the gloom. More on the latest report with Anastasia Amoroso, PGIM's Mike Collins. That's still ahead.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
On track for another week of gains in the equity market. The S&P firmer, the Nasdaq higher, the Russell ripping going into the opening bell. That's the price action. Let's get you some morning calls. Bank of America upgrading universal health services, expecting better margins. Jefferies raising its Apple price target to 2 cents, saying next week's developers conference will serve as an upside catalyst. And finally, Piper downgrading Dollar General, highlighting a notable decline in quarterly comps. More on the retailers coming up shortly. We'll catch up with Anastasia Amoroso of iCapital and Mike Collins of PGIM. That's next, your opening bell, just around the corner.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
This is Bloomberg.
Big question going into payrolls. What on earth do you do with that payrolls report? Top line really strong, the rest of it not so much. Equity futures positive, dancing higher by 0.66% on the S&P. The Russell outperforming. The big cap tech story continues for a sixth consecutive week. Looking for another weekly gain. As the price action in equities, switch at the board and get to the bond market. Yields a little bit higher by a couple of basis points on a 10-year maturity. Back through 360. The bigger move at the front end on a 2-year. All over the place post payrolls, but higher now by 5 or 6 basis points, just short of 440. A touch of dollar strength briefly, it fades. The euro just about unchanged against the dollar. Euro dollar 107.69 and crude higher by 2.5%. Commodities up today off the back of speculation that we get some stimulus from China and reporting from the team here at Bloomberg that maybe China is considering doing something around the property market to support things just a little bit more. 30 seconds into the session, the broader equity market opens higher by almost 0.7% on the S&P. On the Nasdaq, up by 0.8%. One stock to watch at the open, Lulu, topping Q1 earnings estimates and delivering a better than expected outlook. The CFO saying this: a meaningful acceleration in our China sales coupled with lower freight costs contributed to our better than planned performance. Abby has more. Hey, Abby.
Hey, John. Well, after 9 down days in a row, Lululemon, that was the longest losing streak for the stock going back to 2016. It is now up more than 15%. Its best day since June of 2018, and it has everything to do with that China strength that you were just talking about that allowed them to beat adjusted earnings by 16%. Sales were better by 4%. As you mentioned, they raised the full year outlook. A lot of it having to do with that China strength. It also has to do with the fact that they're finally moving through their bloated inventories. They rose just 24% from a year ago in the first quarter when they were up 50% year over year. Gross margins expanded. Executives at the company are saying that has a lot to do with China. They're also planning on opening 30 to 35 stores, many of them in China. So that China rebound that everybody's been waiting for, at least it's there for Lululemon. And it's interesting, John, because retail has been so mixed this year. This is another one of the brands, the higher end brands that retail consumers seem to be flocking toward. They're fashion right and being willing to pay up for this brand. Again, this stock right now up about 15%.
Abby, never mind this year, the last 24 hours. Just a story of contradictions. And Abby, thank you. Abby, looking at Lulu there, absolutely fine flying. Nordstrom just about holding on. Macy's terrible. Dollar Tree telling you an ugly picture for the US consumer right now, and retail all over the place. Lulu right now up by close to 15%. Want to talk about the banks, the financials. Goldman warning of a 25% decline in trading revenue for the second quarter. The President John Waldron saying, quote, it feels like we're going to have a contractionary environment for a period of time. We're now embarking on additional targeted action with headcount. Kaylee has more. Hey, Kaylee.
Hey, John. Well, interesting to see Goldman actually positive here at the opening bell by about 0.4%. But we have to keep in mind the week through yesterday's close, it was down about 4.7%. So this rebound isn't likely to end in a weekly gain for this company. Of course, earlier in the week, we did get reports from here at Bloomberg that Goldman is looking at another round of job cuts, less than 250 jobs this time around. But that's after they cut 3,200 back at the beginning of the year and several hundred last fall. So the third round of cuts in less than a year, as they are contending not just with a 25% slump in the trading business, but other areas as well. Waldron talking about sluggish capital markets activity, the slowdown in deal making that is weighing on investment banking fees as the macroeconomic environment is just more difficult. And we heard echoes of this from Morgan Stanley as well. The co-president, Andy Saperstein, speaking on Wednesday, also said he expects that this quarter will be down year over year, that sales and trading is softer. Investment banking is very challenged, and the industry has been what he described as a sustained trough since last year in investment banking. For Bank of America, though, John, the story is a bit different. We heard from Brian Moynihan, the bank's CEO, yesterday, saying that he expects trading and sales activity to be flattish this quarter. We have to keep in mind, though, that Bank of America is coming from a bit of a different brace because it didn't have quite the performance in that division last year as some of the rivals did.
The bank's doing better today. Katie, for the wrap there. Thank you. Down in Washington, D.C. Nothing defensive about this equity market this morning. The underperformance from utilities, healthcare, the outperformance from materials, consumer discretionary, energy. There's a bit of an attacking pose to this equity market right now, up by 0.9%, even with the yields drifting higher at the front end by 6 basis points back through 440 on a 2-year. The slowdown weighing on earnings from Dell, though, feeling the pressure from weaker consumer PC demand. The company delivering a tepid outlook despite topping Q1 estimates. The stock just about positive. Katie has more. Hey, Katie.
Hey, John. Well, it wasn't as bad as feared, but it still wasn't good. We know that personal computers have been a tough sell. We saw that from HP earlier in the week. We saw it again from Dell today. So let's get specific here. Consumer PC sales plunged 42% in the period ended May 5th to about $2.12 billion. Analysts had been looking for about $2.3 billion. They did fare slightly better when it comes to commercial PCs. That segment brought in about $9.9 billion of sales, which was an 18% decline, but it still beat estimates. It was the outlook, though, that was lukewarm at best. Dell sees revenue between $20.2 billion to $21.2 billion in this current period. Now, on average, analysts had been looking for about $21.1 billion, so at the upper end of Dell's range. You look at what the stock is doing, and it's interesting. It had been lower pre-market. It's bouncing around right now, currently up about 0.5% or so.
Katie, thank you. I'll show you a bigger move than that. Year to date, and Katie, thanks again. Year to date, Apple up by close to 40%. Shares of Apple inching ever closer to an all-time high. We got 2 analysts raising their price targets today ahead of next week's developers conference. Morgan Stanley writing this: the combination of technological improvements and lower price points of the AR/VR headsets is what could make a conference a more significant stock catalyst this year. That stock up just a bit, 181, up by 0.6%. Want to stick on tech? Here's a story for you, buried by the news around the payrolls report in the last hour, but what a story. Bloomberg learning that Amazon has been in talks to offer mobile service to its Prime members in the United States. The report sending Amazon higher and telecoms lower. Ed Ludlow on that breaking news of the last hour or so. Morning, Ed.
Yeah, John, there's a lot to cover here. These are some pretty monster moves in reaction to this Bloomberg reporting. According to sources, Amazon is in talks with Verizon, T-Mobile, and Dish. The idea, according to sources, is to get access to wholesale prices and then offer a low price, $10 per month, or for free, to Prime members to give access to a wireless network. You look at Amazon, up 2.3%, but I think we better take a quick look at the networks themselves, the carriers themselves. Dish is up now, the most since 2011 at one point, up 19%. The idea is that, according to sources, it would give higher utilization for these newly built 5G networks. Whenever Amazon enters a new product category, it sends shivers into that industry. And you look at the reaction to the downside, Verizon, AT&T, and T-Mobile. T-Mobile down 7.6%. That is the biggest drop since March of 2020 on that particular stock. The reasoning being that Amazon can undercut pricing because of its flex financially. So really interesting to see what this means for Prime, but also the future of those carriers.
Fascinating story. Ed, thanks for that. No doubt you and Caroline Hyde will be talking about this a little bit later on Bloomberg Technology. Look out for that in about 2 hours and 20 minutes time on Bloomberg TV. Amazon is doing okay. Dish Network's flying. The rest of the telecoms, it's not looking good out there at all. For the broader market, it's looking okay, better than okay, up 1% on the S&P 500. I mentioned there's so much going on right now. Away from the payrolls report, you've got the China stimulus story, which we can talk about right now. Bank of America's Michael Hartnett writing the following this morning. The tech stocks have discounted a June Fed pause, leaving China stimulus as the bullish June surprise. He says the contrarian call here right now is to buy the Hang Seng and sell AI. Think about the beaten up parts of this market, commodities, EM, resources, and banks. And right on cue this morning, China said to be considering a new package of measures to boost its economy and support the property market. That's what we'll be talking about going through the weekend. For us right now, we get lucky again. Joining us is iCapital's Anastasia Amoroso, alongside PGIM's Mike Collins. Anastasia, you get lucky too, because you've had about an hour to think about this labour market report, because everyone else is still confused by it. What's your take on it?
Well, look, I don't think the report is really as buoyant as the payrolls number actually suggests, because when you look at the household survey, and I do focus on this one a little bit more in this particular report, it is a more expansive measure that takes into account the self-employed people and household workers. And, you know, if you look at that, you do see a little bit of weakness, or at least loosening up in the labor market that's emerging. So I think the Fed is going to focus on that. The Fed is going to focus on the fact that wage growth is running a little bit slower this time around than it did the month before. So I actually think that's a positive, and that's how the markets are certainly interpreting in this. You know, I will say the Fed also has plenty of reasons to keep on hiking rates, because the data, the economic surprise continues to be so resilient. But in a way, they've sort of pre-committed to a pause. And I think given, again, you know, the weakness in the 3.7% unemployment rate, I think they can have enough credibility to pause in June.
Mike Collins, is so confusing. The labour market data at the very headline, payrolls growth this morning, together with claims earlier this week, job openings earlier this week, says there's nothing to see here, no problem. Then you go to the retailers and they're screaming, we've got a discretionary recession. Mike, which one is it?
Yeah, it's a lot of churn, Jonathan, and as Rick Reeder said, a lot of dispersion between winners and losers, not just in corporations, but among people, right? You are seeing that lower income bracket. As Mike McKee reported, African-American unemployment rate is jumping. You're seeing more distressed and highly levered companies really suffer in this environment. So that's something that everybody, including the Fed, really has to keep an eye on. But our base case, you know, when you see this volatility of numbers and it's really difficult to parse them, you step back, say, where are we heading in the big picture? And the base case is that, you know, growth is moderating. We're probably going to be running at 1% GDP in this country over the next 12 months. Inflation is moderating. We'll probably be running at a 3% inflation rate over the next 12 months. You add those together, you get 4% nominal GDP. That's not a world where the funds rate should be 5, nevertheless 6. I think to talk about taking it to 6 is kind of crazy. The markets, as you know, are pricing in one more full hike over the summer. And then kind of remarkably, 200 basis points of cuts from there pretty quickly over the next 17 months or so. So that's a real aggressive set of cuts, maybe overdone.
The environment you described, Mike, sounds like by the NASDAQ 100. The NASDAQ 100 year to date is up by 33%. It's just a phenomenal rally. Anastasia, you've been constructive on tech, you've been constructive on this market. I remember several payrolls reports ago, you talked about breaking out of this tight trading range of 23 to the upside. Anastasia, we've done that. Can you make the argument now with conviction that now is the time to lock in some profits here?
Look, I think in parts of the market, it is absolutely the time to lock in partial profits. And in particular, I am looking at the NASDAQ. I'm looking at the semiconductors. I mean, the rally in semiconductor stocks, for example, has been stunning year to date. It's up 65%. And especially in the last couple of weeks, the semiconductor space has gone parabolic, which we all understand why, because semis are the key enabling technology of artificial intelligence. But anytime you see something move to the upside so far, so fast, so parabolic, you know, you get into an overbought territory, and that's exactly where we are today. And then also, John, I look at the valuations of the semiconductor stocks, and the SOX index, for example, the valuation expanded from 13 times multiple at the October lows of last year to 28 times today. And don't get me wrong, I'm a huge believer in the semiconductor story and the artificial intelligence story. But if I take a tactical investor perspective near term, that's a sector that's looking stretched on positioning, on valuation, on technicals. And so for those reasons, I would want to take profits. And by the way, when you have this setup, you always are waiting for some sort of a negative catalyst. And we don't know which way the Fed is going to move in June, but I think there is scope for a hawkish surprise given how resilient the data has been. So if we have to reprice the path of Fed policy higher, then I think that's the ultimate negative catalyst for semiconductors. By the way,
Next up
if
for that
we get a
debate,
dip, I want to buy it.
As you know, CPI on June 13th. Mike Collins, if we do leave these growthier parts of the equity market tech, you've got to make a decision whether you want to go back into the cyclical trade again. Mike, the cyclical trade just seems to have broken down. China disappointing, Europe disappointing. We reported earlier this morning that China might be considering stimulus measures. Mike, what gets that cyclical trade going again?
The Fed pausing for sure, not only skipping, but kind of signaling eventually, maybe over the next few months, that they really are done or really close to done. And the market's pricing of all these cuts have to continue to be in place, right? If the whole yield curve elevates higher toward that 5.25 funds rate, there's more pain to come, right? Multiples will compress, credit spreads will widen, the economy will weaken. So these cuts that are priced in may be aggressive in the near term, but wow, they have to really be sustained there for the economy to continue running.
Mike Collins is going to stick with us alongside Anastasia Amoroso. Coming up, the Fed's last word before going quiet.
We're getting close to a point where we can sit for a little bit. We really should skip, not pause. I don't like the word pause.
The conversation up next with Anastasia Amoroso and Mike Collins.
What's happening on Wall Street?
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Access the financial world on demand.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're getting close to a point where we can sit for a little bit in terms of policy. I don't know if we're exactly there yet, but I am in the camp increasingly coming into this meeting thinking that we really should skip, not pause. I don't like the word pause, but skip an increase.
The committee at the Federal Reserve found a consensus on at least one thing. Don't call it a pause, call it a skip. Governor Jefferson leading the way this week, skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. President Harker backing him up in many ways. We should at least skip this meeting in terms of an increase. We can let some of these things resolve themselves, at least to the extent they can, before we consider at all another increase. Federal Reserve officials getting in the last word ahead of the quiet period going into the next decision in just under 2 weeks away. Anastasia Amoroso, Mike Collins back with us. Anastasia, you mentioned this, and forgive me for jumping in a little bit prematurely, with regards to the Fed's next move. Morgan Stanley's Ellen Zentner saying this after the payrolls report: we do not believe today's report was strong enough to meet the bar for the Fed to hike in June, but it raises the risk that the Fed could hike in July. Anastasia, is that the way you're thinking about it too?
I think that's the scenario, John. I mean, if the Fed didn't really pre-commit, if the Fed didn't really make all the statements about the potential to have the leeway to pause, I think they would probably go in June. But, you know, first of all, it's still only been a couple of months since the banking turmoil, and it's really just subsided in the last month or so. You know, second, you know, the data has been somewhat mixed. So I think that does give the Fed some flexibility. But the main point is that Powell really said pretty strongly, saying we have the luxury to wait, given how much we've tightened already. And I think they're likely to use that luxury. And here's the thing, John, you know, we've had the Fed who went from hiking 75 basis points to hiking 25 basis points. But the next part of the tightening cycle may be that they maybe hike once a quarter. And, you know, if that's the case, then, you know, July might as well make sense.
We spoke to Mohammed in the last 50 minutes or so. Take a listen to what he had to say about the Fed's next move.
63.
We also know that the U.S. economy is increasingly dualistic
The
between
bill
what's
is
happening in manufacturing in general and what's happening in services. And all this, including today's job reports, complicates the Fed's policy challenge. Whether you call it a skip, a pause, or hike, it certainly complicates it.
And Mike Collins, it makes it complicated for all of us. Mohammed mentioned what was happening beneath the surface of the economy. Manufacturing is screaming cut rates, services screaming you could stay where you are, maybe even hike. Mike, what are you meant to do with that information? How much weight do you put on each?
Yeah, it's really tough, right? And the markets are kind of right in the middle. They're pricing in about half of the hike in June and the other half in July. So they're pricing in one more hike for the cycle, which feels about right. It's hard to argue against that. But again, by the time, if they do skip in June, Jonathan, by the time the meeting in July, which is almost 2 months from now, our best guess is that you will continue to see more evidence that growth and inflation are moderating, and the Fed will probably be done for the cycle if they skip in June, would be my guess. And remember, you have to take all of the hikes into account, not just at the Fed, but globally. You add all the rate hikes around the world, Jonathan, over the last couple of years. It is multiples of anything we've seen in our lives. You add quantitative tightening, and as Anastasia said, the bank lending standards tightening pretty significantly. All that points to the funds rate is as high as it should go for the cycle.
I said this a little bit earlier. There's nothing boring about it right now. That's for sure, trying to work out all this stuff. Mike Collins, Anastasia Amoroso, to the two of you, thank you. Just always a stellar lineup on Payrolls Friday, and appreciate your time, as always, too. The equity market on the S&P 500, positive by 0.8%. The Nasdaq positive as well. The Russell doing nicely. In the bond market, yields were higher off the back of the report, higher again by 9 basis points at the moment, 443 on a 2-year. Further down the curve, 10-year maturity yields up there by 5 to about 365. Let's get you some sector price action Here's Abby.
A solid rally for the S&P 500 indeed, John. In fact, the index is heading to its third up week in a row, the longest weekly winning streak since March. As for today, not surprisingly, with the strength, we have most sectors higher. In fact, we have 6 of them higher by more than 1%. Materials and energy, the top sectors, up about 2% or more. All the stocks in each of those sectors are higher. That's the kind of strength we're seeing today. As for the AI rally, it is strongly in place over the last 2 weeks. It's interesting, though, John. Earlier, NVIDIA had crossed the mark to $1 trillion market cap. Again, that stock now down. But over the last 2 weeks, you can see that tech, the stocks, NVIDIA and C3 AI, all on fire as the AI craze continues.
Over the last 6 weeks, NASDAQ 100, 6th weekly gain, longest weekly winning streak going back to July 2021. Abby, thank you. Up next on this program, we'll get you to the weekend. We'll take a look at the trading diary into the weekend and beyond.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Equities positive on the S&P 500, up again on the NASDAQ. Connor Russell doing nicely here. Going into the weekend and beyond, let's get to the trading diary. It looks a little something like this. President Biden speaks at 7 p.m. Eastern time about avoiding a default. OPEC Plus meeting in Vienna over the weekend. We get U.S. durable goods and ISM services numbers on Monday, plus Apple hosting its Worldwide Developers Conference as well. The UK Prime Minister, Rishi Sunak, visiting President Biden in Washington on Wednesday. And finally, got another round of jobless claims coming up on Thursday. Just a programming note, on Tuesday, I'll be flying out from the East Coast to the West Coast and catching up with good people over at PIMCO. Manny Roman, Dan Iverson, fantastic lineup. Some of the best people out there, including the former Fed Vice Chair, Rich Clarida, as well. Tiffany Wilding, all of the above. You think of the name? They're going to be with us on Tuesday on the West Coast live from California. I'll see you then.
think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
to kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind. but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life
Simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas